pressure we will see. But I think a lot of it is, the world is changing a bit.
How many more data points would it take for you to see? 3, 4?
I don't know. I want to see evidence that significant bottlenecks are occurring, and I don't see that in the data. I'm not going to say 3 or 4. I would want to see sustained evidence. But I think the wage settlement evidence is pretty good. 2%, same as it's been for the last decade. It's been 2, 2, 2, 2. Yes, there are temporary bottlenecks. But what should the central bank do to respond to a temporary bottleneck? Think of price changes. We saw a big rise in timber prices. Okay, people don't have to buy timber. And so the price of timber now is halved. So I think we just have to watch an economy recovering from a shock we've never seen before.
Danny, just to conclude things, someone wrote into me just moments ago, and I think you'd agree with them. The only mistake has been to be too hawkish, never too dovish. That's been true over the last 10 years. Is that what you worry about now?
I think that's right. I mean, I don't understand, how is it an error to sit and wait and watch? Just wait. Don't do anything more than you're doing now, and watch as the economy resolves itself. Look at the hawkish folk who I've been on your programs with many times over the last decade, telling us inflation was going to take off. That's what it was going to do. You had to raise rent. All of that was nonsense. So I think the error has always been in a recovery. You tighten too quickly. There's really no error to be had in waiting and looking and seeing. And I think that's what's going to, and we're going to see in the UK, the potential is the government is going to withdraw the stimulus, perhaps in September. In the US, these unemployment benefits are going to go away, and then we'll see how the economy bounces back. But, wait, look, watch, and don't make another big mistakes like George Osborne did in the UK in 2010.
Danny, we need a round table, don't we, with you and Andrew's sentence? Yeah. We need to do that again.
Oh, no.
So we get sentenced back. Like the good old days. I thought we're friends now.
We are good friends. We both think Brexit is a disaster.
There we go. You agree on something.
He still wants to raise rates, of course.
Does he? Well, that's what I thought. Maybe that would be the optimal round table for a programme like this.
What's the discussion?
The discussion is that you want low rates forever and he wants higher rates. Danny, it's good to see you. It's good to hear from you. Danny Blanchford, Dartmouth Professor of Economics.
Up again.
I'm trying. And former Bank of England Monetary Policy Committee member. Lisa, do you know that the two of them, when they were on the MPC, they fell out afterwards, and we did this nice kumbaya get-together. They made friends on my show many years ago after the UK voted to leave the European Union. That's the one thing they could agree on.
Yeah, and you want to bring them on
15 years.
You want to bring them on to disagree.
On rates specifically.
Yeah, you want them to disagree because you want some good dissent. You also want some drama because this is a boring market and there are no hawks left, and there is a question of whether this is the right approach or whether there should be perhaps a little bit more pushback. Did you see this paper that the ECB analysts put out about how low inflation expectations breeds low inflation?
The one in Kit Duke's note this morning.
Yeah.
Kit's note over at SocGen. I saw that, yeah.
Yeah, I thought it was interesting, sort of the whole idea of Japanification. And it sort of brings this cycle in the forefront of central bankers' minds. If they say that inflation's going to stay low, does that keep inflation low? How much can they kind of
so they should commit to making a policy mistake. They should say.
I'm trying to stir something up for you.
It's going to be too high.
No,
what's wrong with the both of you? Taylor Riggs, Lisa Brower's board this morning. Equities might print an all-time high later in the session. Taylor, what does that tell you, that we could have record highs and you're both bored of it?
M2 money supply, right? All the money, John, sloshing around. We're having great conversations this morning of not only the monetary effects, but the fiscal effects as well. And it is unbelievable. The NASDAQ 100 at a record high, and sort of a hint of that defensiveness underneath the surface and the resiliency of these markets to shrug off any of those inflationary concerns. How many record highs can you have before you shrug it off? This is going to be, what, the 13th?
This is another one. We'll talk about the pandemic a little bit later as well. Dr. Gigi Granville, Johns Hopkins Center for Health Security Senior Scholar. We'll do that later from New York City. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden is traveling to North Carolina today to encourage more Americans to get the COVID-19 vaccine. His trip to Raleigh comes 10 days before July 4th, the president's stated target date to see at least 70% of adult Americans at least partially vaccinated. The CDC says that so far, slightly more than 65% of U.S. adults have had at least one dose. China has filed a lawsuit against Australia at the World Trade Organization over anti-dumping measures on some Chinese goods. The measures in question target Chinese products, including wind towers and stainless steel sinks. Earlier this week, Australia said it would appeal duties imposed by China on its wine exports. And the world's biggest maker of Bitcoin mining rigs is suspending sales of machines for spot delivery, hoping to prop up prices. Bitmain Technologies says it has stopped selling new equipment after prices for top-tier rigs plunged by about 75% since April. China's crackdown on crypto mining is causing miners to abandon their operations and dump machines on the market. And Siemens has raised its financial targets and announced its first share buyback since 2015. The German industrial giant will buy back as much as nearly $3.6 billion of shares over a 5-year period, starting next year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We know don't have plans to close full offices and tell people to work from home. No. We want people to come into the office. With the vaccination rate as high as it is now, and the measures that people have taken, while clearly COVID-19, it looks like there's going to be another wave, but hopefully that doesn't translate into hospitalizations or more serious illness.
That was Jet Staley, the Barclays CEO from New York City this morning. Good morning. Tom Keene taking a long weekend alongside me, Lisa Bravitz as always, and Taylor Riggs as well. It's the price action this Thursday morning, shaping up as follows on the S&P 500, 42.52. We advanced 21 points. We're higher, firmer, stronger by 0.5%. Yields are higher too by a single basis point on a 10-year to 149.36 in the FX market. Euro stronger off the back of some pretty decent confidence data out of the two largest economies in the Eurozone, France and Germany. Euro dollar 119.46, advancing there 0.2%. The bank CEOs, Lisa, they are not holding back. Jet Staley, we don't have plans to close the offices. We want people to come into the office. He's pretty clear about that.
Come into the office, but you need to get vaccinated if you do. That is Morgan Stanley, JP Morgan not far behind. And it really is showing how the private sector is leading the way when it comes to vaccination policy at this point.
Get it done and get back to work. Taylor Riggs, the thing's pretty clear going deeper into summer, isn't it?
100% clear, John. And I think that this has been sort of the big debate on Wall Street, of course, not only within New York City, but global Wall Street, as we think about how the private sector takes back perhaps maybe some of those big decisions, John. So we think about how to get an economy reopened.
Yeah, Taylor, you say global Wall Street, though, Lisa, it's been pretty clear, with maybe the exception of Barclays and Jet Staley, that the European banks are taking a slightly, subtly different way of thinking about this.
Yeah, it's that they see that working from home really works, and also that it might maybe save money.
Just a little bit on floor
might
space,
be part
on
of
office space, maybe. Dr. Gigi Gronville joins us now, Johns Hopkins Centre for House Security Senior Scholar. Doctor, great to catch up. Chancellor Merkel speaking in the last couple of moments. Here's the headline. We're worried about the COVID-19 Delta variant. Doctor, why should we be worried about the COVID-19 Delta variant?
Yes, the Delta variant looks like it's a little more transmissible than some of the variants we've dealt with before, but thank goodness it's still, the vaccines are protective. So if you haven't gotten vaccinated, this is the chance, this is your opportunity to get immunity before you get exposed, because it's looking like you will be exposed to this virus, so don't delay.
So, Dr. Gronville, what's the logic of places like Israel closing or perhaps delaying the reopening to foreign visitors because of the Delta variant, because 100 people got diagnosed with COVID, given the fact that people are not getting hospitalized, and frankly, these vaccinations are protective against the variant?
Yeah, well, not everybody is able to respond to the vaccine in the same way, and perhaps you don't want to take that risk. There are still maybe children who haven't been vaccinated, so it's taking an opportunity that maybe could have been taken early in the pandemic to try and limit the import of infections if you had the ability to test and to do contact tracing.
And this is coming at a time when Germany's Angela Merkel is saying that there needs to be more coordination between the European region in terms of the travel guidelines. What's the threshold in your mind in terms of vaccination rates, in terms of hospitalizations, where we can get a sort of more consistent protocol globally in terms of travel, in terms of testing, in terms of quarantining?
Yeah, I think you're not going to get a good answer about that, except that that's not enough what we have right now. There's still a lot of problems with access to vaccine, and so we need to make sure that the people who are most vulnerable and the people who are interacting with others and transmitting it to each other, that they are also prioritized for vaccination, because it's a lot of the younger people that are transmitting these variants.
Doctor, I'm curious how you respond to people who say you look at countries like the UK and Israel with the best vaccination rates, and yet they can't reopen their economy because, to Lisa's point, you see a rise in infections, sometimes asymptomatic cases. Some people say that sort of undermines the confidence in the vaccines. How do you respond?
Well, 2 doses are better than 1, and so that's part of the problem with the UK, that there are still a lot of people who haven't had their second dose. So I think, I don't know what to say to that, except that for you personally and your family, you will be better protected if you have both doses of the vaccine. And there is even some discussion now about whether or not people who are particularly vulnerable, who have had the one-shot J&J vaccine, whether they might consider topping it off with a second shot, because the second shot seems to be more protective.
Do you see a time in the near future, similarly to the flu 100 years ago, where we just learn to live with the virus?
Well, we're not going to eradicate this virus. Any thought that that we're going to be able to take this away from the planet is that's just not going to happen. It took a lot of effort, and it was very particular conditions to eradicate smallpox from the planet. And we're not going to be able to replicate that here, especially because this virus can also infect a lot of different animals. So we are going to live with it, but let's learn to live with it with a high vaccination rate and high testing. We can do that, and we can certainly limit severe disease.
Doctor, we've got to leave it there. Thank you. Dr. Gigi Gronville there, the Johns Hopkins Centre for Health Security Senior Scholar. We've got a case study playing out in real time in the UK right now with this Delta variant, Lisa, and we have a country that has got, I believe, 60% of the adult population with 2 doses of a vaccine now. So how this plays out is going to be pretty key.
And the fact that younger people are the ones that are getting sick, but they're not dying. They are getting hospitalized, but you're not seeing the hospitals overrun. So at what point does this become, as you've mentioned many times, the onus on the individual to protect themselves and frankly to have protection for the rest of society, and frankly just get back to life? For those who are vaccinated, they're going to be fine.
When a personal decision no longer threatens the healthcare system more broadly. Are we at that point right now, Lisa? I guess that's the open question.
That's the open question, especially because, to Gigi's point, Dr. Gronville's point, there are places that still don't have that many vaccines, so they might be less available in terms of access, and also younger individuals, right? I mean, younger kids who might not be as vulnerable. However, if they're not vaccinated or even eligible, do we really want to enter into that shift?
I've got to say, for New York City, Taylor, with the exception of going on public transport, getting in an Uber or a cab and wearing a mask, things are pretty much getting back there, aren't they?
John, you know what I thought about the other day? It was like a year ago, I was on the Open and I made a joke about how traffic seemed to be back. I take that back. 2 days ago, traffic was more back than it was a year ago.
I've got to say, going into the weekend, it is very, very busy in New York City. It's the New York tourism, the domestic tourism. Lisa, do you think that's what Mr. Gorman and Morgan Stanley's made his point about? That if you can return to New York to go to a restaurant, we want you back in the office?
Yeah, basically they're saying if you can have a normal life elsewhere, why not have a normal life coming back to the office? I think the distinction here is whether people will want to work from home, whether there is a generational shift where younger people say, look, why should we come into the office if we can do our jobs just as well? And so I think that the proof now goes beyond the pandemic and goes to a quality of life, a style of life in terms of efficacy. And that's going to be the divide.
And maybe an older gentleman who wants a longer weekend, just to have a stroll around Manhattan, have a cigar without a mask on. Who am I talking about?
Tang mimosa.
Who am I talking about? He'll be back with us on Monday. Equity futures 42.52. We advise 0.5%. From New York City, for our audience worldwide, this is Bloomberg.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
I'm not surprised also to hear the language of Fed Chair Jay Powell. They're committed to going at this gradually.
I think more surprising in the market was hearing taper talk start.
What they don't want to do is take a dramatic and drastic action to really result in a sharp shift.
Whether it's fiscally or consumption, there's really no cliff out there that we see right now.
Of course, the economy is experiencing some frictions. We rebooted the global economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Tom Keene is out of the building alongside me, Lisa Abramowitz and Taylor Riggs. Looking at the equity market right now, 42.52 on the S&P. We advanced 21 points on the S&P 500. Sterling comes in just a little bit, now negative on the day at 139.55 with a Bank of England rate decision. Lisa Abramowitz, what's the detail that you see right now?
Just that it's no drama, right? That basically there was no rate decision. They voted unanimously, to speak to your point about very little dissent, to maintain benchmark interest rates and that they hold government asset purchase plan. It had $875 billion pounds. So basically no change, no indication of tightening. We'll have to wait to see and parse through the details to see whether there was any more hawkish decision. But you could see yields falling here as people weigh this as them remaining as dovish as they can be.
And a parting dissent from the chief economist Andy Haldane, largely anticipated. That's the result of all of this, voting to reduce the asset purchase target. The asset purchase target, the gilt purchase target right now, 875 billion in its entirety. Sterling down to 139.42. Taylor, we've got to try and get you excited about the day ahead of all-time highs on the cards, maybe on the S&P 500.
You're not going to let me live that down, John. Certainly interesting day. The resiliency of these markets to shrug off some of the inflationary, perhaps some of the more hawkish tones that we get. Raphael Bostic, Mr. Bostic, of course, from the Atlanta Fed, really striking that tone, John, yesterday, hinting that he's looking at a taper maybe in 3 to 4 months. That sets us up nicely for Jackson Hole September, and perhaps maybe some of the divergence or not between the individual central banks as equity markets say, all right, we're in it and we're going higher.
And everyone else just shrugs their shoulders as we look down the path towards another all-time highs. The Bank of England right now, we will not tighten until there is clear evidence of progress towards our goal. Lisa, 139.28 now on sterling against the US dollar. We're down about 0.25% there.
Yeah, although they did say that downside economic risks have been reduced. However, everyone seems to be saying this as we end up heading toward some sort of recovery. That said, the balance of the decision-making at this point is to the more dovish side. And I think that that is clear from each central bank meeting that we hear. Frankly, it's going to have to be Fed Chair Jay Powell that changes the tone.
Let's turn to the price action. 42.51 on the S&P 500. Equity futures drifting higher this Thursday morning. We advance 0.5%. Cable, negative on the day. That's a weaker pound, down by 0.25% against the US dollar. Sterling, 139.26. Euro dollar, 119.41, advancing a little more than 0.1%. And yields basically unchanged on a 10-year at 148.68. Lisa, unchanged on a 10-year after all of the surprise and action after the past week.
Yeah, a thrilling day. Honestly, though, this is telling because the fact that you have all of these Fed officials coming out and saying, actually, these inflationary pressures could be significant. The fact that you're not getting any move today is significant, that people are shrugging that off. I will just say, if you're playing the drinking game, the Bank of England coming out and saying the T word, transitory, when it comes to inflationary pressures. My question is, if we have such a robust recovery, if we have such a tight labor market, why is it that we're still getting nearly 400,000 Americans filing for unemployment benefits each week? Today, we're expecting less than 400,000 for the first time since the peak of the pandemic. However, still a high 380,000. The question that I have is how much progress is being made? How can we dismiss these data points as just noisy versus actually telling in terms of the composition of which jobs are coming back? Are we at a services recovery yet? Also getting the first quarter GDP, the third read of that. 1 p.m., the U.S. is selling $62 billion of 7-year notes. Perhaps there will be drama here. It does not seem like, though, that is the case based on the recent auctions that we got. Yesterday's 5-year sale went pretty well. And then 4:30 p.m., the Federal released the results of the stress test. All 6 biggest U.S. banks are expected to pass with flying colors, expected to double their dividend payments and their stock buybacks. The question that I have really is the market question of how people will trade this. Basically, is it baked in, or do people see this as a point of profitability going forward? Have banks become the new utilities, John, in terms of just generating cash and being a reliable bet rather than a more fickle one that fluctuates on trading volumes?
That has been a theme for many years now, hasn't it? Lisa, thank you. Let's turn to Luke Cower, UBS Asset Management Asset Allocation Strategist. Mr. Cower, good to see you, a good old friend. Luke, as you know, central banks, when they change, they take baby steps. And the baby step that I think we're witnessing over the past week, both with the Federal Reserve and now with the Bank of England, seems to be just reassessing the balance of risks around the outlook and also around the outlook for inflation. What's your take on that, Luke?
John, imagine if your baby's first step wasn't a first step, if it was, a pole vault or a high jump. That's the shock kind of the market had to deal with, even though we're talking about things that were only out, in 2023 and do require a lot of progress to be sustained and to be actually realized. So in kind of looking at the Fed and digesting how that might hit cross-asset action, what we're thinking about is kind of the 2 reasons why Chairman Powell said that the dots did move up. One reason is that economic activity is coming in, so there's more confidence within the Fed that the baseline outlook that they achieved in March, that they outlined in March, is going to be achieved. So on the one hand, this suggests that continued inline data is going to be a force of pressure that continues to pull forward dots. And if you're trading short-term interest rates, all you have to do is be more confident than the Fed that economic outlook is going to be achieved. You can kind of continue to push the timeline on that front. On the other hand, it's clear that the inflation risk, the balance of inflation risk, that jumping to a net 13 Fed officials thinking that the risk to core PCE are tilted to the upside, that also influences the forecast, the balance of risks, and when they think tightening might be warranted. So on the other hand, you have what we would expect to see over time is that the ebbing of these inflationary pressures and upside risks, just as these do turn to be less persistent, to avoid using the T word, inflationary forces. So kind of putting this together, I think what you would expect coming out of the FOMC, and this is something we've adjusted to take account of, is that real yields break-evens trade-off has moved more into the real yield side of it, driving moves in the 10-year. That, of course, is going to also have an effect on the dollar. So it's about seeing less widespread dollar weakness and the scope for that deteriorating on the margin. What I will say is encouraging to say from a risk perspective is that even as we've had, a broad dollar rebound in the wake of the FOMC, it's rallying more against the DXY components than it is against the EMFX component. So this suggests this isn't about a kind of a dumping of risk currencies, so to speak, or a less positive view on risk. It's just a reevaluation of the Fed, real yields, and what that means at the front end.
So, Luke, the more we hear the T word, transitory, the more people buy risk assets. Exactly as you said, they're going further into risk in order to get returns. There is a question at what point the Federal Reserve, the Bank of England, other central banks start to take action just to curtail some of the moves that we've seen. And I'm thinking of the mortgage market in particular. To Taylor's point earlier, this question of the composition of which assets the Fed may pare back on its purchases. How much are you looking to the mortgage market to feel some pain from that as people start to question the elevated housing prices?
Well, I think the main reason why the Fed at this point is still purchasing in both asset classes is because it knows, as we know, that by purchasing MBS, it's sucking treasury vol out of the market. And, one of the Fed's goals is to, use asset purchases to a certain extent to calm markets, calm market volatility. So I think the signal from the Fed that it's going in either direction in terms of both purchasing less and moving to raise rates at some inconclusive point in the future is really just a signal, they will both be, that the Fed is moving more from a vol suppressant mode, a purely vol suppressant mode, in order to get us through the crisis and get the rebound completely on track, to one where the Fed is going to be more a source of two-way volatility. I think that's the real read-in from that, not necessarily the nature of the components of the underlying asset purchases.
Luke, are you surprised by the cross-asset resiliency with equities at record highs, the VIX with a 15 handle, and a very calm and well-behaved bond market?
To a certain extent, yes. I think the markets have been able to digest this quite well, a more hawkish than expected Fed. And I think kind of when we're looking through what and why, what we talked about earlier in terms of the dollar being stronger, real yields being stronger, how far can that filter out? What's very important lately is that it hasn't filtered out really all the way to commodities. Copper had a pretty bad move down, but that's kind of alleviated lately. Oil's still pushing forward to new highs. So the market is still trading this idea of we're still getting very, very good activity going forward. The Fed has cut off right tail inflation outcomes. Therefore, it's safe to buy equities. In our view, there are limits to this, particularly the way that it's been kind of playing out under the surface with the rotation to growth. That's not necessarily something we want to chase right now. Right now, the equities at the headline level, we do think are due for a breather. And if you look at over the past few months, equities have really moved sideways on a global basis and on the S&P 500. So we're not necessarily looking for a lot of downside, but think there will be an attractive dip potentially to buy going forward in the coming weeks. And this is just to do with the market needing to digest that the second derivative is turning, the Fed is becoming less supportive.
Luke, always great to catch up. I promised you we wouldn't talk baseball. We won't. Has UBS got a call on Euro 2020? Have you got a country, a nation?
I mean, I have to say the Swiss, right?
The Swiss.
Do you?
I guess, maybe.
Why do you have to say the Swiss?
UBS, I guess.
Really?
The house view, right? You got to go with house view? You got to go with Switzerland. UBS asset management, asset allocation strategist Luke Cower. Luke's become so corporate.
I was about to say the exact same thing. Really?
He's become so corporate.
He would never say
I know.
the New York team.
So just pick a side.
Is that
Seriously.
long hair corporate?
Not sure, to be honest with you. Used to be very strict over at UBS, Taylor. What you could wear, what you couldn't wear, the kind of styling you might need. I'm not going to go there. I'm going to go to a headline for the Bank of England. This is how you say goodbye to your dissenting chief economist. It's wrong to undermine the recovery with premature tightening. Lisa, that's the headline coming out of the Bank of England this morning.
Saying goodbye to the last dissenter. I think a lot of people thought that he was, don't let the door hit you on the way out. People thought that he was a little bit on the fringe. That said, how much is it actually healthy to have that fringe view? I don't know. You think you want
dissent
that?
is good.
Yeah.
Andy Haldane goes over to a think tank now and writes some provocative pieces, maybe.
For Project Syndicate?
gets you thinking for whoever. Coming up at 8 a.m, Peter Cheer, Academy Securities Head of Macro Strategy. Looking forward to that conversation with Pete in about 50 minutes from now. Equities up 21 on the S&P, 42.53 almost, up 0.5%. From New York City, heard on Bloomberg Radio, seen on Bloomberg TV, this is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. U.S. officials are confirming that details of the genetic makeup of some of the earliest samples of coronavirus in China were removed from an American database where they were initially stored at the request of Chinese researchers. The U.S. National Institutes of Health says that the data, first submitted to the U.S.-based Sequence Read Archive in March 2020, were requested to be withdrawn by the same researcher 3 months later. The Vietnamese government plans to administer 300,000 to 500,000 COVID-19 vaccinations a day in the next 6 months, according to a post on the government's website. The Ministries of Health and Defense are said to be close to completing warehouses capable of storing vaccines at extremely cold temperatures in 7 locations across the country. And bullish, a cryptocurrency exchange backed by a group of billionaires, including Peter Thiel, is in SPAC merger talks with Far Peak Acquisition, Bloomberg's learned. The deal could value bullish at nearly $12 billion, with an agreement possible in the next few weeks. The final valuation could change depending on the price of Bitcoin. And John McAfee has been found dead in a Spanish prison cell shortly after it was announced he would be extradited to the U.S. to face charges of financial crimes. The creator of the McAfee antivirus software has been jailed in Spain on U.S. tax evasion charges. A Spanish newspaper has reported that he appeared to have taken his own life. He was 75 years old. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax
in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I'm not surprised also to hear the language of Fed Chair Jay Powell. They're committed to going at this gradually. The real unemployment rate is still elevated. The bond market is not signaling substantial inflation. And so this is going to be a gradual process.
As you were in the bond market, that was Brian Levitt, the Invesco Global Market Strategist. Tom Keene out of the building with me, Lisa Abramowitz, Taylor Riggs. I'm Jonathan Ferro. Is the price action this Thursday? Equity futures 42.51 up 20. We advance 0.5%. In the FX market, euro dollar 119.44. Yields unchanged at 148.51 on a US 10-year. If you switch up the board and get to the FX market, sterling is what I want to look at. Cable with a leg lower. That's a weaker pound against the US dollar, 139.23. That's a weaker pound, Lisa, as the Bank of England pushes back against any chance of a hawkish pivot a la the Federal Reserve anytime soon.
I think the Fed's going to have to move first, and that's the message that we're getting from central bank after central bank. I mean, honestly, at what point is this just going to be a race to the bottom continually, even as we see inflation pick up?
Do you remember that race back in 2014 between the Bank of England and the Federal Reserve? Who would hike first?
Yeah.
Going to be waiting a number of years maybe for even the Fed to make that move.
Honestly, at this point, it's the move of indicating that they're going to slow the purchases. That's first, and frankly, that'll be a hawkish shock. What did Luke Kawa say? What if the first step was a first leap? That's considered a leap.
I called it a baby step, and he said, imagine if your baby's first move was a somersault or something like that. Thank you, Luke Kawa. Josh Wingrove joining us now, Bloomberg White House reporter down in D.C. Josh, always good to catch up, sir. Let's just start with following the infrastructure talks. I've been told it's days and not weeks. We've got to get it done. Otherwise, we're going alone. And then I was told the same thing 3 weeks after I left the building. What's going on, Josh?
Yeah, they seem to have reached near the sort of cusp of a deal or an actual deal last night. A couple of senators coming out calling it a quote-unquote framework, others saying, well, we're not quite there yet, but they did get this sort of golden ticket, which is a meeting with Biden himself today at the White House. The White House said they wouldn't do that unless there was progress. The top line numbers kind of depend on who you ask right now, but it looks like something on the order of $559 billion in new spending. There's ways that they can sort of muck that up by stretching the timeline and including stuff that would have been spent anyway to push it over $1 trillion and call it a win. Democrats in the House, though, are signaling that for them, the reconciliation process is part of this deal. In other words, stuff they did not get in this can maybe get rolled into reconciliation. So with regards to a bipartisan infrastructure deal, this is sort of like, letting the least popular person at the table order the appetizers because you know that you still get to order the main course.
Well, Josh, that's exactly what I was going to go to. The idea here of, isn't this a loss for the Democrats, giving the Republicans the upper hand, that 1.9 to 1.2 trillion to now $559 billion infrastructure plan, continuing to ratchet down while the prospects of further plans getting passed kind of start to wane?
Yeah, they wanted more for sure. Republicans will definitely hold this up as a win. Democrats are frustrated, of course, particularly the progressive wing are frustrated, but there is that still shoe to drop. Now, reconciliation for those of, the sane viewers who are not following the vagaries of Senate parliamentary procedure, there's a lot of big question marks on it. A, we don't know what all 50 Democrats in the Senate will support, Joe Manchin, Kristen Sinema, et cetera. B, we don't know what can go in reconciliation. It's always sort of up in the air. You'll recall that the $15 minimum wage went over the side of the ship when they realized that would be sort of out of bounds. So Democrats have this sort of second bullet to fire, if you will, but they don't know yet what they can put in it. Remember, he's got that whole third plan as well, the families plan. They kind of want to do all of that through reconciliation. That might go to the fall. It's a lot of moving parts here right now, but Biden is trying to have this sort of smaller field that Republicans can support. Incidentally, we don't, just because 10 Republicans support it doesn't mean 60 senators do. And then try to get something enough on reconciliation that progressives don't sort of lose their mind and, accuse them of selling out to the Republicans.
Josh, one reason why it's always great to speak with you is because you walk through the halls of Capitol Hill and you find out where the balance of energy is. Is it all in infrastructure? Is basically the pandemic over and no one's talking about it, even though in the rest of the world there still is a lot of cases and a lot of concern about getting vaccinations?
I mean, yeah, infrastructure and other things. The pandemic has definitely gone down the list. One thing that we're going to see Joe Biden do today is go to North Carolina to try to essentially beg people to get shots. We really have two Americas right now where higher vaccination rates in some states are, in stark contrast to lower vaccination rates in other states, in particular through the U.S. South. That Delta variant is starting to spread, and Biden is kind of torn on his messaging, right? He wants to do this July 4th celebration at the White House. They're going to have 1,000 people, Independence Day from the virus. Depending on where you live in the U.S., this thing is very much over or it's very much not. And the problem is that a lot of folks where it's not over tend to be the ones that most likely to believe it is over and they're not getting the vaccine. So in Congress and the White House, this is a balancing act. Biden wants to talk about reopening. He wants to talk about all the shots they've given. 150 million people in the U.S. have had both shots. That's a staggering number as compared to, a few months ago. But my gosh, this thing is still roiling out there, in particular that Delta variant.
Josh, forgive me if I circle back to some of the infrastructure conversations as we try to round this conversation out. And how are we thinking at this moment of defining what infrastructure is and what it isn't?
I mean, it's definitely getting more to bricks and mortar. This was sort of the early animating discussion. Joe Biden, takes a broader view of it. They think that anything that facilitates people entering the workforce can be, considered infrastructure, including things like the caregiving economy and whatnot. Some of that did get pushed into the third bill, which means it wasn't necessarily on the table for these conversations. What we're talking about now is a little more sort of, core, what you might call core infrastructure. And again, $550 billion over, a shorter time frame. They'll probably call it over $1 trillion over 10 years when you roll in stuff that was sort of on auto spend anyway. There's consensus that this is needed, but we'll see. One of the changes that they've done is sort of raid money from COVID aid for around telecoms. So, that doesn't sound like people that are that five-alarm desperate to add more infrastructure funding to the pot.
Hey, Josh, it's good to see you. Josh Wingrove, thank you, and good luck. My good friend Anne-Marie Horder joining the team down in D.C. That is a big dose of New York down in Washington. You'll be okay, Josh. Josh Wingrove down in D.C. looking a little bit worried about how much New York has just gone down to D.C. as Anne-Marie Horder joins the team. Just Anne-Marie's style of New York down in Washington, do you think they can take that?
Of course they can.
See.
I mean, come on.
See.
You think that they're such lightweights down in Washington, D.C.?
I think they're lightweights compared to what takes place up here, don't you?
Well, I mean, the gloves come off here. I mean, if you ride the subway, honestly, I think it's a different kind of gloves coming off in Washington, D.C. than here.
Waking up at 8:30 compared to getting up at 6. It's a different world. Come on.
I'm still trying to recall the governor and replace it with a movie star, you guys.
There you go. Thank you, Taylor.
Honestly, I don't know. I think New York tough is, there's a soft underneath that.
All right. I'll take your word for it. We'll catch up with Peter Cheer on what's happening down in Washington, D.C. and get his view on what it means for New York and the markets on Wall Street. We'll do that in about 30 minutes. Before we get there, we need to catch up with Bill Dudley, too, the former New York Fed president. Looking forward to that. Equity futures up 21 on the S&P, 42.52, up 0.5%. Yields unchanged, 148.68. Wasn't an insult of New York, Lisa. I'm with New York.
Yeah,
I'm very much New York.
Yeah, you love how clean the streets are?
I love New York. Don't even try and frame things that way. 42.52. This is my home. This is Bloomberg.
Welcome home.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
From New York City, live on TV and radio for our audience worldwide, here's the price action this Thursday morning. About an hour away from jobless claims in America. Equity futures drifting higher, 42.51, up 20. We advance 0.5%. A nice move on the S&P. The Nasdaq too, we advanced there almost 0.6%. Keep in mind, just away from an all-time high, a couple of inches away, 42.57 is the intraday all-time high, the S&P 500. One to watch once we get the cash open a little bit later. In the bond market, 2s, 10s and 30s. In your bond market, we look a little something like this. A summer Thursday feel to a bond market with yields pretty much unchanged through the curve. Your 10-year 148.85, unchanged there on 30s too at 2.1090%. Let's get to something that has changed in the last 30 minutes. It's the shape of sterling, cable, the pound against the US dollar, a gap lower. The pound right now, 139.18. If you were positioning for a hawkish surprise, maybe you got a surprise. For everyone else, it's more of the same. That transitory theme coming from the Bank of England, and it's bye-bye to the Bank of England chief economist, Andy Haldane. He dissents. He wants a reduction in the overall size of the asset purchase programme. The rest of the Bank of England say farewell, good riddance, maybe. Not my view, just perhaps. Some people thinking it at least. The pound right now, 139.14. Taylor Riggs with some stocks this morning. Hey, Taylor.
You know, John, we got some interesting comments yesterday from Barry Sternlicht talking about the peak hype cycle. And of course, some of that comes, as he mentions, Clover Health and some of the other SPACs in just terms of the money sloshing around in the system. So I'm taking a look at Clover Health. I'm also taking a look at some other of the meme stocks, Sundial and Torchlight Energy, which we cannot stop talking about given the wild swings that we continue to see. And of course, stories out this morning that fundamental managers who sold GameStop, well, maybe some of them are regretting it, given the massive run-up that we continue to see. And so those are shares that we continue to follow. Let's take a look, though, at some of the other fundamental stories. We have to talk about the reopening and MGM, where we are on that upgrade to a buy at Deutsche Bank with a $54 price target. Tesla's also a fundamental story here. You're getting a lot of competition from Porsche, Audi, Mercedes coming, making an aggressive push in that EV space. Regions Financials, of course, with the Fed stress test for the big banks. What does it mean for some of the regional players, given the massive underperformance that we've seen in June? That reverses this morning as we're up 0.6%. And can we talk about Beyond Meat? John, I have very interesting comments on this. Duncan said that they still are selling some of the breakfast sausages.
Okay.
JP Morgan saying that their checks showed that there weren't the Beyond Meat breakfast sausages. I'm a Beyond Meat fan, I think, but I'm not sure how I feel about the breakfast sausage.
So just walk me through this. Are we struggling to track whether they're still selling the Beyond Meat breakfast sausage?
Yes, and there's also like a Taco Bell plant-based thing going on. It's a very, very delicate debate.
Lovely. Do you eat Taco Bell?
I do.
You do? Okay.
Yes.
Good to know.
So does
Beyond
John.
Meat, down by 1.3%. Do I?
Yeah, I often see you there.
Yes, of course.
Yeah, of course.
Yes, I do. Are we paid by? No, we're not. No, I don't. Joining us now, Bill Dudley. I'm pleased to say the Bloomberg opinion columnist, Princeton University senior research scholar, and former New York Fed president joins us too. Bill, it's good to catch up with you. And I enjoy your pieces, and your piece out this morning. It's a little bit technical, but I want you to run through things. When the Bank of England comes out with a rate decision, bank rate means a lot for a lot of people in the UK, for business loans, for mortgages. The Fed funds rate is a different beast, and you're pushing back against the continued use of targeting the Fed funds rate and using it almost, Bill. Can you just walk me through the thinking here?
Well, the federal funds rate used to be important because reserves in the banking system were quite scarce, and so banks had to trade the federal funds rate, federal funds between themselves to satisfy the reserve requirements. That's not the situation today. The banking system's awash in reserves as the Federal Reserve continues to buy $120 billion of treasuries and agency mortgage-backed securities. So the federal funds market's become very different, very much smaller and much more idiosyncratic than it has been in the past. The motivation for this piece was the fact that the Fed last week had to make a technical adjustment to two short-term interest rates, the rate they pay on overnight reverse repurchase agreements and the interest rate they pay on reserves, 5 basis points each. Why? To supposedly keep the federal funds rate closer to the middle of its target range. Why are we targeting the federal funds rate in the first place at this point? It's no longer an important market. The Fed has the ability just to pay the interest on reserves. Why not ditch the federal funds rate target and just set the interest rate on reserves at the level that's appropriate with the monetary conditions that the Fed seeks to accomplish.
Well, that's your simple solution. In your words, 3 words, drop the target. Bill, could you anticipate a communication issue around doing that if they were to do that this year?
I think they could explain it very easily. They would no longer have to make these technical adjustments that I think are more confusing than illuminating. Also, another thing that they need to do is exempt reserves from the leverage ratio. As they add more reserves to the banking system, that's putting downward pressure on rates. The whole reason why they had to make this technical adjustment to the federal fund, to these 2 interest rates, push the federal funds rate up, was the fact that they're flooding the banking system with reserves. And banks don't want the reserves because of the leverage ratio, which is starting to bind as a capital requirement for banks. So if you exempt reserves from the leverage ratio, then that problem goes away as well.
And Bill, you're talking about the glut of deposits that you're seeing on some of the bank books, with some banks even saying to their corporate clients, we don't even want your money because it is getting to be excessive. Just taking a step back, how much is the change that you're proposing evidence that we're going to remain in this environment with a system awash in cash and the Federal Reserve pumping money continually into it, even though there is so much cash? How much is it just sort of an acknowledgement of that reality over the near and frankly, not even that near term?
Well, I think that we're going to be in a system where there's lots of reserves in the banking system for some time to come. First of all, the Fed's not going to stop their asset purchases quickly. It's probably going to continue well into the fall. So the balance sheet is going to continue to grow. The amount of reserves in the banking system are going to continue to grow. And then when it finally decides to start to normalize its balance sheet, the balance sheet is so big now, it's going to take a long time to get it back to, the $1.5 trillion of excess reserves that we had prior to the pandemic. So I think we have a system where the interest rate the Fed pays on reserves is the primary tool of monetary policy. Let's acknowledge that.
I understand, Bill, the argument that the Fed wants to continue with their very easy money policies, just simply to allow inflation to pick up and allow employment to get to a better place. However, people have pointed to certain frothier areas, in the mortgage market in particular. Do you think it's advisable? Do you think that it would harm the progress that the Fed is allowing to happen in the economy for them to pare back on some of the mortgage debt purchases that they make every month?
I think it would have an effect more on expectations about future monetary policy. We tell the market the Fed has now acknowledged that they made substantial further progress towards their goals. And so people would change their expectations of the timing of tightening. So I don't think it would be that important in the narrowness of the housing market. I think it would be quite important as a signal of monetary policy and the timing of tightening of monetary policy.
Is that the preferred method versus...
So I don't think they're going to do it. I don't think they're going to do it. I think they're going to be pretty patient here.
What about perhaps maybe more of an equal weighting taper? I think a la December 2013 and a discussion of $5 billion in treasuries, $5 billion in MBS. Is that just more of an easy path to go?
Well, I think that you have a template from the last cycle. And so to deviate from that template, you have to have a really good reason. I don't think they have a really good reason. I think if they deviate from what they did last time, it just raises a bunch of questions. What are you concerned about? Why aren't you following the game plan that you followed last time?
What did we learn from last time around, Bill? The lessons of the last time we reduced asset purchases and eventually actually had some balance sheet reduction several years later.
Well, I think it went, in all fairness, quite smoothly once the Fed communicated clearly about what the sequence was going to be. First, we stopped the asset purchases. We tapered the asset purchases down. Then we raised short-term rates, and then we finally start to normalize the size of the balance sheet. So this time, the market has a template to look at. Last time, they didn't, and so there was a lot more uncertainty about what the Fed was going to do in the last cycle compared to this cycle. I think it's one reason why the markets are pretty comfortable with what the Fed's up to.
Do you think that there's too much Fed speak at this point? We've been talking about how there's very little dissent, and there basically is a Fed official every hour speaking.
Well, there's always probably too much Fed speak. I mean, the thing to pay attention to is really the chairman, the vice chairman of the Board of Governors, and the vice chairman of the Federal Open Market Committee. So Powell, Clarida, and Williams.
Bill,
what they say really.
Are you saying ignore the Fed presidents when they go around doing speeches?
Yes.
I wouldn't say ignore the Fed presidents, but put a lot less weight on them because they're just one member of the committee. I mean, the big three set the agenda for the Federal Open Market Committee. The committee's not going to do something if those three people aren't on board. So it's about weight. Don't ignore the presidents, but don't put too much weight on what one individual president might say.
Bill, just how much they influence the conversation inside the Federal Reserve when you have those FOMC meetings, when you had the likes of Plosser, Fisher really pushing back at the turn of the last crisis going through the recovery, just how much do they influence the conversation?
I think they influence the conversation because they offer a different perspective, and I think diversity of views is actually important. Diversity of backgrounds is actually important in terms of getting good monetary policy making. But at the end of the day, the committee is going to go where the consensus is. So if someone's always dissenting, they sort of marginalize themselves because they're not relevant in terms of figuring out where's the committee going to go in the future. Right now, there's a lot of disagreement about when should we start to taper asset purchases, because people are uncertain about the state of the recovery and how fast will it cut into unused labor resources. There's quite a bit of disagreement right now about timing. But the people that matter are Williams, Florida, and of course Powell, because they're the ones who are going to determine the ultimate timing.
Hey, Bill, it's good to catch up, as always. Good to see you. Great piece, too. Available on Bloomberg.com and on the Bloomberg Terminal. Bill Dudley there, Bloomberg opinion columnist and former New York Fed president. Just a little bit of insight there, Lisa, into the inner workings of the Federal Reserve.
And this is the reason why markets are shrugging off some of the more hawkish dots from last week's Fed meeting. Basically, people are saying that wasn't Fed Chair Jay Powell. It was not John Williams from the New York Fed. It wasn't Rich Clarida. So we don't have to pay attention to those dots. My question is, what is the purpose of all these Fed presidents, the regional Fed presidents, coming out and having a more hawkish tilt, warning about froth, warning about potential upside surprises to inflation, if everyone just ignores them anyway? If basically it is going to be a Fed Chair Powell and nobody else?
I think some healthy dissent is important. Are we getting that now from this Federal Reserve? I remember one interview with Jim Bullard, I think it was out on CNBC in the last couple of months, where he almost said that he was waiting for Chairman Powell to start the conversation about tapering. They are waiting for the chairman to almost cue what they can and can't talk about.
Do you think that that's what it is, internal pressure, or do you think that they don't want to rattle markets too much and then push the goals further out? I mean, the idea here that markets get very concerned by any hawkish tilt, even if it's a dot. The fact that there was that sort of flattening in the yield curve does get people's attention, but still, is this what counts as dissent?
I don't know. Look, I will say, in a world where you've just spent the last couple of years talking about this brand new framework, your hands are tied to some degree. So maybe that's why this defense of this more hawkish stance is just a little bit more muted than it otherwise be. Though I have to say, Lisa, it's got louder in the last couple of weeks. It's Bostic, Bullard, Kaplan, just again and again and again. 42.51 on the S&P, advancing 0.5%. Lisa Abramowitz, Taylor Riggs, Jonathan Ferro, Tom Keene back on Monday. Equities pushing all-time highs, up 0.5% on the S&P. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden is traveling to North Carolina today to encourage more Americans to get the COVID-19 vaccine. His trip to Raleigh comes 10 days before July 4th. The president's stated target date to see at least 70% of adult Americans at least partially vaccinated. The CDC says that so far, slightly more than 65% of U.S. adults have had at least one dose. The Chinese Defense Ministry says that exercises by the People's Liberation Army aircraft in the Taiwan Strait are a necessary response to a regional security situation. There was no elaboration. During a briefing in Beijing, a Defense Ministry spokesman urged the U.S. and other countries to abandon what he called a Cold War mentality and to stop talking about a Chinese military threat. Authorities in Sydney are rejecting calls from some health experts for Australia's most populous city to enter lockdown to control an outbreak of the Delta strain, the strain first identified in India. That's despite case numbers almost doubling to 31 over the past 2 days alone. The world's biggest maker of Bitcoin mining rigs is suspending sales of machines for spot delivery, hoping to prop up the prices. Bitmain Technologies says it stopped selling new equipment after prices for top-tier rigs plunged by about 75% since April. China's crackdown on crypto mining is causing miners to abandon their operations and dump machines on the market. Global News 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
traders. I looking to trade today euro. Here is the chance. We are placing an order to buy euro at 119.38. Okay, the order placed to buy at 119.38. So if you're looking to copy this trade, please do so. So we'll make a trade. Stay with me, and I will speak to you later after we will fill this order. Okay, stay safe. I'll speak to you later, guys.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday...
Also, guys, I need to cancel order to buy Bitcoin because it takes very long time to fill this order. As you can see, we tried to fill this order at 36,106, but it moved on. The price jumped high, and I don't see any chances that it will move down unless it will change its direction. In this case, we'll have to sell short. So in the meantime, please cancel order to buy Bitcoin, and we will wait for another time. Okay, guys, stay safe.
Disclosure. It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The conversation about crypto is a minor percent of any dialogue we have with any company worldwide. It's just not terribly important. Could crypto become a really important asset class one day? Sure. If there was a digital dollar, a true digital yuan, that will change however, that would be much more impactful than any other, like a crypto.
Fink there. Larry Fink, the BlackRock chairman and CEO from New York City this morning. Good morning. Alongside Lisa Abramowitz and Taylor Riggs, I'm Jonathan Ferro. Tom Keane out of the building. Here's the price action. Equity futures, 42.51, up 20 on the S&P. We advance 0.5%. Euro dollar 119.40. We advance about 0.1% there. Slightly stronger euro. Business confidence out of Europe this morning. French business confidence, German business confidence, it gets better. Outside of that, in the bond market, yields unchanged, 148.85 on a 10-year, unchanged. If I was to tell you 12 months ago, this is where we'd be with international travel, I think you might have questioned that. Lisa, if I was to tell you 12 months ago, this would where we'd be with UK travel, even with these kind of numbers out of the UK. The Prime Minister speaking this morning, more than 60% of adults receiving 2 COVID-19 vaccinations, 83% receiving at least one. And he talks about the opportunity. That's the operative word here, opportunity, the opportunity we all have now to open up travel through the double jab. I just can't believe we're not there yet.
I would agree, and I think that it's interesting to see places like Israel, which has one of the most vaccinated populations out there, just closing their borders to foreign travelers for even longer because of an increase in the Delta variant, even though the hospitalizations haven't picked up all that much. It just talks to this threshold, this fear that people have of COVID that perhaps goes beyond what we're seeing in the hospital system.
The airline business right now is just really tough for international travel. We've talked about that a million times over the last couple of months. For domestic travel, that was meant to be the support, Taylor, the support for the likes of American Airlines. American Airlines have been aggressive about putting capacity back on, and we've seen it continuously over the last couple of weeks. American Airlines have had to cancel flights because they can't get the staff, Taylor.
You know, John, we spoke with the Southwest CEO on the close yesterday, and I brought up American Delta trying to scramble to hire 1,000 pilots. He literally says that they can't bring workers back fast enough. Some of this, of course, is not just the airline industry. This is a broad U.S. global issue of a labor shortage, trying to bring labor workers back into the workforce. But it really speaks to the travel industry specifically, John, about how quickly demand came back, perhaps maybe we were caught off guard just a little bit, though everything I'd read said this was going to be the roaring 20s. Brace yourself.
Yeah, Taylor, you make the good point, though. This is just one case study, one example of a much bigger, broader story, particularly for the US economy. And Lisa, we've asked continuously, when do we start to address these issues? Well, the answer to that is right now. My question is, when do we resolve them? When do we start to see real signs that they're being resolved? Is that the end of August, deeper through summer, beginning of September, maybe later?
You've talked about humility, and we heard the same kind of tone out of Fed Chair Jay Powell. The uncertainty, as Tom says, make it up. They are making it up because we don't even understand why there is this friction in the labor market. I mean, do you buy this idea that it is childcare? Do you buy the idea that it is a skills mismatch? Or do you buy the idea that it's because people are getting enhanced unemployment benefits and want to just stay home? I think that the evidence is really unclear exactly what the main driver is, probably a little bit of all.
Oh, September's the date in the diary then, right? When the kids go back to school?
It's my date in the
diary. The
diary.
additional UI expires. That's when we're going to find out.
You know, John?
Yeah.
All I know is my cauliflower rice at Chipotle is up 5% because they have to pass on the costs from higher wages.
But is that a one-off shift in the price level or the beginning of something more persistent?
If it's transitory, they wouldn't be passing on permanent price increases.
No, that's not
to
the definition of transitory. That's a one-off change in the price level. Persistent would be if that was to happen again and again and again.
It's a rate of
Is this just
change.
a one-off change in a price level or the beginning of something more persistent?
It's a rate of change question, and actually speaking exactly to that rate of change question, there was a story on the Bloomberg today about used car prices and how actually they're poised to decelerate. Yes, they're going to still be increasing, but not at the same pace as some of the supply chain kinks get worked out. So, I mean, to that point, John, that would seem to confirm the transitory idea.
42.52 on the S&P 500 this morning, getting close to all-time highs. It's the same debate. It's value versus growth, growth versus value, banks versus tech. Take your pick, any flavor. Let's bring in Dave Wilson, a Bloomberg stocks editor, for more with his chart of the day. Morning, Dave. Run us through it.
Well, what we're talking about here, John, is correlation between the S&P 500 pure growth and pure value indexes. So you're talking about a subset of the broader S&P 500, specifically companies that best fit into these growth and value categories. Now, we've certainly seen some back and forth over the past year or so. Value stocks kind of taking the lead for a while as, we got back from the lows of March of last year. And more recently, in the past month or so, it's been a bit of a shift toward growth. And what you get out of that is that, the correlation just isn't there the way it has been historically. In fact, you're looking at the lowest level since October 2000 in terms of the relationship between these pure growth and pure value indexes. So it really does matter more than it has for more than 20 years which way you go when it comes to the growth versus value argument. And that really plays out, when you look at, say, the past 3 years, you've got to try to basically pure growth and pure value track each other until the lows of last year, and then things kind of start going their own way.
All right, so what is the why behind this? Is this an idea that a lot of fund managers come on and say, which is it's time to be a stock picker? Is this the idea that the rotation under the hood of the equity indexes has been abnormally significant?
Well, perhaps more of the rotation, because you have to go back more than a decade to really see the last time that value stocks kind of led the way. And, arguably more recently, that's been flipped on its head a bit. We've seen a return to growth. I mean, still value one of the best performers on the year if you look at, various factors that people pay attention to when it comes to investing. That said, I mean, with the turnaround we've seen more lately, again, you kind of get value and growth each going their own way as opposed to moving together, which has been the tendency over time.
Dave, good to catch up. Really interesting stuff, and that debate continues. I'll catch up with Jonathan Gulliver, Credit Suisse, and Savita Subramaniam at Bank of America a little bit later about clinging onto that idea that the cyclicals can outperform from here. And also, we need to talk about the fiscal plan down in D.C., or the lack thereof, Lisa. Peter Cheer running much of what is driving the market could be linked to doubt about the size and effectiveness of fiscal stimulus. Pete's going to join us in about 5 minutes, Lisa.
Yeah, but you know what's weird? Whenever I ask people about this, they all say it's not priced in, any kind of fiscal stimulus. So if this is the disappointment, then it has been priced in. And if it's not priced in, then are we taking also tax hikes off the table, which also could be a potential downside risk to stocks?
Oh, so it's bullish or bearish? Which one is it?
I'm going to stay with bearish on both sides.
Okay, fantastic. Thank you.
I'm going to be consistent, true to form.
I am not shocked. Nobody is.
Well, I mean, honestly, you've got the fiscal stimulus on one side. People say that you know, people haven't priced in the boost, and on the flip side, people say that they've priced in the potential negative drag from higher taxes. So, actually,
yeah,
could it be a bullish surprise?
Okay.
Look at that.
Thank you. I think the wonderful Lisa Bravitz, Taylor Riggs, and Jonathan Ferro. TK's back with us on Monday, taking a long, well-earned long weekend. 42.51 on the S&P 500, advancing about 20. We're up 0.5% this Thursday morning. 35 minutes away from jobless claims in America. We'll run through the economic data for you a little bit later in the next hour. For our audience worldwide on radio and TV, this is Bloomberg.
A bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there. I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, you know, those things have to be, you have to be mindful about that. But I think it's incredible what's been achieved so far. But, you know, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think. And to be a part of that is really special.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
bump in the road is the road to recovery and inflation.
Powell is very optimistic that we are going to get a robust labor market recovery, that inflation will be contained.
I'm not surprised also to hear the language of Fed Chair Jay Powell. They're committed to going at this gradually.
What they don't want to do is take a dramatic and drastic action to really result in a sharp shift.
He's just been saying essentially, wait, look, and we'll respond if we need to, but there ain't no inflation problem.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Lisa Abramowitz and Taylor Riggs. I'm Jonathan Farrow. TK taking a long weekend. He'll be back with us on a Monday. Looking at the price action right now, 42.52, advancing 21 points on the S&P 500. Lisa, your takeout last week, it's as you were.
I mean, honestly, it's amazing to me that we're finding that the melt up into new highs is just basically treated with a shrug. But it's just same old at this point, given the fact.
Position open on euro at 119.38. As you can see, that's a long position. All of you guys who decided to trade euro, well done. You're in. So stay with me. And for other people who just wondering why we don't sell straight away, why it moved down, you need to get our strategy and you need to learn how to day trade. You need to use arbitrage, you need to use other things that will be explained when you will get the strategy. Other people who follow our trades, they already know, or our clients, our customers, what we're doing. So stay with me and follow my trades, and we will finish this trade in profit. I'll speak to you later, guys. Okay, guys.
The July.
Let's place stop on profit for euro, and we're going to place at 119.40. Okay, stop on profit place at 119.40, just right here. So whatever happened, you will close your trade in profit. Okay, guys, stay safe.
That there's too much debt or too much deficit. Washington is not going to heed a call. You know, but my favorite example of this is the 2017 tax bill. And, you know, no disrespect to anybody who put that together, but you know, understand that the red line for Republicans was they weren't going to go into deficit any more than 1.5 trillion over 10 years. Yeah. Now, when you're talking about, you know, how to manage a deficit increase, that's a sign that you're really not serious about bringing the deficit down. And that's the way Washington is these days, regardless of party.
Yeah, and Terry, if it weren't that way, people probably would be accusing it of not recognizing the reality we're in of pretty low bond yields. Since Tom Keene is not here, I'm going to channel him and talk about how close we are to the 2022 midterm elections. Is this fiscal package that we're seeing coalesce in Washington, D.C. going to be viewed as a win for the Republicans or a win for the Democrats?
Yes. The answer to that is yes. But infrastructure spending is bipartisan. Members of both parties want to see better roads, bridges, fundamental infrastructure. They all want to be able to go home and say that they did that. And the key, you know, the key for me at the same time will be seeing if they can goose them along more quickly. You know, there's in my home state of Pennsylvania, there's been now a 10-year-long project just to redo 40 miles of old interstate. And if things are going to take that long, there's going to be a lot of frustration out there in the world. So one thing that they're going to need to do is goose their states along and make things go a lot more quickly in order to gain the maximum amount of political benefit out of it.
That's the best way of answering a Tom King question.
Yes.
Yes.
I'll take a note.
Terry, thank you. Terry Haynes, Fangea Policy founder down in Washington, D.C. Just still, Lisa, an immense amount of uncertainty about the outlook here. I think there was a lot more conviction at the beginning of the year about what we would get from D.C., and now a lot of that's faded.
Although, if Terry Haynes is correct, and the headline number is $1 trillion, it's only $559 billion of new spending, but still you could say that the headline number is $1 trillion, and it does not come with tax hikes, then is it a wash? If no one's going to pay for it.
I'm hearing you. Do you want me to answer?
Yeah, I mean, this is the issue, right? I mean, for market participants, how much does it matter if you don't have it offset? That's, to me, the issue. Yes, please answer.
Well, right now, I think the market's speaking for itself, isn't it? Just nothing. Tumbleweed in treasuries after a repricing over the last week, back to 148. Taylor, as you pointed out, comfortably below 150, just in and around that level now. We've settled down.
Unbelievable. A 15 handle on the VIX and is settling down within the bond markets, John, as you alluded to, despite some of the whipsaws we've seen on the long end of the curve. It was an average 5-year auction. I believe it was yesterday or 2 days ago. Very, very calm, even as we're thinking about how you get through a 5-year rate cycle hike with higher inflationary pressures. And there is still demand for some of that debt out there.
Jobless claims moments away in the United States of America. From New York City this morning, good morning. This is Bloomberg.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more. They might just need just some practical experience in an Australian kitchen.
I have not from Australian friend. Now back in the kitchen, I have many friends.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
From New York City for our audience worldwide, live on TV and radio, this is Bloomberg Surveillance alongside Taylor Riggs and Lisa Abramowitz. I'm Jonathan Ferro. Tom Keene will be back with us on Monday, waiting for some economic data in America. As that starts to come out, let's just run through the price action briefly. 42.53 on the S&P 500, positive about 0.5%. Jobless claims coming in a bit firmer than expected. It's the wrong kind of upside surprise. 411,000 against an estimate of 380, just down from the previous month of 412. Waiting to see if we get a revision there, Lisa, but coming in just a little bit hotter than expected.
Yeah, and this to me is the conundrum. How much can we read into this data that has been incredibly messy? How much does it give us a true read on how many people are filing for jobless claims? Because if people really are looking at a tight labor market, why are we seeing 411,000 individuals filing anew?
Durable goods coming in a little bit lighter too, at positive 2.3%. We were looking for something closer to 2.8%, coming off the back of a previous read of negative 1.3%. Are we done with the big surprises in either direction, do you think now, Lisa, as we work our way through the initial reopening?
When you look at the surprise index from Citigroup, it does seem like that is the case. We're getting to a more normal state. The question is whether we've gotten to peak surprise upside, right? The idea being 10-year yields ticking lower on the heels of this. No drama, though. But still, this idea here of peak growth kind of getting eked into this data.
Did we get a move in a bond market of like half a basis point?
Half a basis point. It was pretty dramatic.
148 on 10s. Taylor, you're pouring through the data too. Your take?
You know, you have a Federal Reserve that continues to focus on these labor markets. We heard from Jay Powell on Tuesdays. He continued to say this was interesting. He expected the jobs market to be better in the last few payrolls report. And unfortunately, when you sort of get like a jobless claims of 411 versus 412 last week, it sort of reiterates that unchanged nature with the Federal Reserve really focused on the labor data.
Let's bring in Ira Jersey, shall we? Bloomberg Intelligence Chief U.S. Rate Strategist. Ira, to begin with the economic data, your reaction, please.
Yeah, it's uneven, and I think that that's been a trend that we've seen over the last couple of months, and the bond market obviously doesn't like it when you have a slowing in the second derivative. So basically, you know, things are still in an upward trajectory, but they're not as quick maybe as they were in March and April of this year. And I'm looking at some of the durable goods numbers, and when you look at the revisions along with what we have, it's basically as expected. So, you know, even though the headline may have missed expectations, the fact is that we've had these upward revisions now that for the April data. So it's making it seem like it's more unchanged. As we get more and more of this, I think that the bond market is going to continue to be range bound, because people are going to wonder, hey, are we really in this upward trajectory for the long term or not? And that's going to be a big driving factor for Treasury yields.
We just got some more of the initial jobless claims data showing that the revised outlook from last week, the prior initial jobless claim was actually revised upwards. Again, the wrong kind of surprise, to 418,000 initial jobless claims. Ira, is there something deeper that we need to be taking from these numbers, especially as a number of states start to roll back some of the enhanced unemployment benefits, that the labor market really is not coming back as quickly as people said, and it has to do with something more pervasive, more persistent possibly, than simply just either matching people with jobs or reducing some of the employment benefits?
Well, I think it's a little bit of everything. So, more people are obviously being laid off, and part of that may just be that there's not work to be done. Where again, this is a very uneven recovery, right? Where we saw this big reopening and a lot of benefits from that reopening, but now that's fading. And keep in mind, the initial jobless claims are only half of the equation, right? So that's only how many people are being let go, not necessarily how many people are going to be rehired, because there are certainly a significant number of industries where you will continue to see big rehiring, particularly the hardest hit sectors. So as hotels and different entertainment and recreation functions, as those reopen, you'll continue to see probably growth there. But again, it's that second derivative. So while we already had some really large increases in employment in some of those sectors, the pace of growth in that those sectors in terms of jobs is going to start to slow just a little bit. And that's one of the reasons why I think a lot of markets are going to kind of be range bound for a little while until we get some clarity on exactly how far this recovery can go. And quite frankly, for the market anyway, for the bond market, the Federal Reserve turning more hawkish doesn't help the case for higher yields, because not so much because they're going to necessarily raise interest rates soon, but because as they talk more hawkishly, people are going to worry that they're going to make a policy mistake because of all the fragility that still exists in the general economy. And there's still a lot of demand for risk-free assets, even though the Federal Reserve might be pulling back on its asset purchases later this year or early next year.
Ira, always good to hear from you, sir. Ira Jersey there, Bloomberg Intelligence Chief US Race Strategist. Joining us now is Stephen Stanley, Amherst Pierpont Securities Chief Economist. Stephen, are you getting a clearer picture of the economic data at the moment with the incoming data over the last couple of weeks?
Well, I think the bottom line is, look, the economy, at least in the short term, is overheating. It started in housing, manufacturing now, certainly the labor market. I think basically demand has recovered faster than supply. Hopefully supply will catch up soon enough. But for the moment, that seems to be the overarching story.
You've demand catching up with supply. Quit rates are at an all-time high, and there's a record number of job openings. Is there a labor shortage, or is there a skills shortage?
Right now, there's a labor shortage. I mean, you look at who it is that's complaining, in terms of companies the most vehemently about not being able to hire people. And it's for the most part, it's firms on the lower end of the skill set. So I think it's really more a shortage of warm bodies at this point. And, for all the reasons that Chairman Powell and others have laid out, chances are that things are going to kind of ease up over the next few months as we move into the summer and then into the fall. I think things will start to normalize.
Stephen, we've seen a number of states throughout the United States reduce some of the enhanced unemployment benefits over the past few weeks. I'm wondering whether we have any preliminary data as to whether more people actually went out and got jobs, whether this actually eased some of the frictions we've been talking about.
Yeah, I think it's a little early yet. I did see anecdotally that there was a little bit of an uptick in inquiries on some of the job search sites in the states that announced that they were cutting the benefits early. But look, the federal benefits numbers lag by a few weeks, so we don't have any hard data yet for the states that have ended the benefits. We're probably not going to see it in the payroll data to any meaningful extent until the July numbers, which come out in early August, because the June survey period was the week before the first tranche of states cut the benefits. So I think it's a little early just yet. We may start to hear some anecdotes, but we're not going to get hard data on this for at least a few more weeks.
Stephen, your view right now on how this is playing out at the FOMC, do you think a lot of this makes sense?
Well, I think what we learned last week is that they've been surprised to the upside for both the economy and inflation, and they're kind of backpedaling a little bit from, you know, their game plan coming into the year, which was to be on hold for a very long time. My guess is they're going to kind of be kept on that defensive stance. I think the inflation numbers are going to be high, at least for another month or two. I do expect that the labor market data are probably going to start to get incrementally better over the next few months. So I think they're going to continue to be surprised to the upside, and I think they're probably going to end up moving a little more quickly than they had originally envisioned.
What does that look like, Stephen, then, relative to what they envisioned?
Yeah, so my assumption at this point is that the taper announcement comes at the September FOMC meeting. They start to actually taper in October, which probably puts me about 3 months ahead of the consensus. And then I think, you know, we get a rate hike around the middle of next year, which again, you know, maybe puts me, you know, 3 to 6 months ahead of certainly where the Fed is, and maybe a little ahead of the market consensus as well.
So, Stephen, how are they going to communicate that, given the fact that Jay Powell has reiterated his dovish stance, and it seems like just some of the regional Fed presidents, like Jim Bullard, agree with you that a 2022 rate hike is in the cards?
Yeah, well, right now, as Powell and others have indicated, they're really not focused on rates just yet. The first order of business is asset purchases. They have to begin to taper those, and I think most people on the committee would like to end asset purchases before they start to raise rates. So, you know, to the extent that they're feeling like maybe they need to raise rates a little earlier, that argues for an earlier beginning to tapering and then a quicker process. And I think that's going to be a key difference between this time around and 2014. I don't think they're going to have the luxury of moving very slowly on the taper process. I think they're going to have to get that done more quickly this time than they did last time around.
And that's the worry a lot of people have. Actually, Stephen, it's good to catch up and get your view on things. Stephen Stanley there, Amherst Pierpont, Securities Chief Economist. Just off the back of this data, dollar a little bit weaker, dollar index a little bit lighter. We shave about 0.1% off the dollar index. Just to turn to the broader market, your bond market, basically unchanged, almost down about 0.5 basis point on a 10-year yield right now. Lisa, still south of 150.
I'm struggling to understand, though, with some of these downside disappointments, the idea of downside economic surprises that we've been seeing, how we could get to a place where we accelerate the tapering and we accelerate the rate hike. What would be the trigger for that? And that's what I'm thinking about right now. Would it be labor market progress? Would it be inflation that seems to be more persistent? Based on what we're seeing right now with auto prices and the potential deceleration there and lumber prices, not seeing where that comes into play either. So yes, this is a worry, to echo what you were saying, but I'm just not seeing it necessarily played out in the data just yet.
It's that commitment to being late from the Federal Reserve. They've basically wrote into their framework that we're now going to be data dependent, not forecast dependent, outcome dependent, which will leave them to be late by definition, Lisa. And if they're late, there's this concern that once they do start to move, they have to move more quickly.
Well, but that is predicated, and I agree with you. That's predicated, though, on the idea that we will get inflation that will pick up more materially. And I think that that really is the question. I mean, none of us know the answer to this, but if people are worried about that, why are we not seeing inflation expectations pick up materially?
Yeah, coming up on the program in the next hour at the Open, I'll be catching up with Savita Subramaniam of Bank of America. We'll be catching up with Jonathan Golub of Credit Suisse as well. Going into that, equities approaching all-time highs, 42.52 on the S&P 500. Taylor Riggs, a final word before I run on this equity market, climbing back towards record highs.
Record highs and across the board, 25 basis points on the 2-year. We go nowhere, John.
Pretty dull elsewhere, isn't it, Taylor? Taylor Riggs, Lisa Bravis, Jonathan Ferro. More of us tomorrow. Tom Keane will be back with us on Monday after his long weekend. Do we get to call it a sabbatical when Tom takes time off?
I'm sure you will, so it's not about whether you get to or not.
I will call it that on Monday when he returns. Your equity market, 42.52. Heard worldwide on Bloomberg Radio, seen worldwide on Bloomberg TV. For our audience worldwide, this is Bloomberg Surveillance.
With the First One News, I'm Rishka Gupta. The sea view side of a beachfront condo tower collapsed in the Miami area town of Surfside early today. The collapse trapped residents in rubble and twisted metal and sent a cloud of debris throughout the neighborhood. Firefighters were seen pulling survivors from the concrete debris. In a tweet, Miami-Dade police said one person has died in the collapse. U.S. officials are confirming that details of the genetic makeup of some of the earliest samples of the coronavirus in China were removed from an American database where they were initially stored at a request of Chinese researchers. The U.S. National Institutes of Health says that the data first submitted to the U.S.-based Sequence Read Archive in March 2020 were requested to be withdrawn by the same researcher 3 months later. And President Biden is traveling to North Carolina today to encourage more Americans to get the COVID-19 vaccine. His trip to Raleigh comes 10 days before July 4th, the president's stated target date to see at least 70% of adult Americans at least partially vaccinated. The CDC says that so far, slightly more than 65% of U.S. adults have had at least one dose. California Governor Gavin Newsom is set to face a recall vote after petitioners collected enough signatures to trigger an election. Newsom has faced scrutiny for his efforts to control the pandemic with strict lockdowns, which fueled the movement to remove him from office. He was criticized for dining without a mask at a restaurant last November while telling Californians to avoid social interactions. Global News, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
I am concerned about inflation overshooting by more and for longer. And I'm also worried that we'll see a second half of the year where the economy is running really hot, first and foremost the US economy, and that will have spillover and spillback effects into the global economy.
That was Alex Weber, UBS chair, talking about the hopes, the fears of faster inflation for banks. Certainly, faster inflation would be a good thing if it steepened the yield curve and led them to more profitability. Since the end of May, the S&P financial sector actually is down 4.7% on that flattening yield curve. Now, we have the CCAR reviews, the stress tests by the Federal Reserve. We expect results today, 4:30 p.m. Jeff Hart, excuse me, will be watching that. Piper Sandler, senior analyst for research. Jeff, thank you so much for being with us. What are you expecting out of the stress tests today?
Yeah, good morning. You know, I'm actually expecting it to be much less eventful than in the past. This is kind of the first non-pandemic CCAR under the stress capital buffer methodology. So, I mean, we're unlikely to get specific dollar amounts kind of from the companies that we've gotten in the past. And so there'll be probably less information out there, which is going to make it harder to be able to actually call winners and losers, you know, tonight as opposed to over the course of the next year.
Jeff, what's your expectation in terms of how the market will respond, given the fact that the expectation is for all of the banks to pass with flying colors and to be able to buy back more shares and pay out bigger dividends?
Yeah, I mean, it sure doesn't seem like anyone should fail, and that, you know, all these banks passed last year and they've built a lot of capital kind of since then, so that shouldn't be too much of an issue. I mean, the thing that could get interesting is to the extent that someone's stress capital buffer, as the Fed calculates it, changes meaningfully from what it was last year. I mean, that could inject some excitement into it, but it seems like it's going to be, I think, a fairly straightforward exercise. We'll kind of see what kind of results we end up getting out. But I mean, the bottom line good news is the banks are going to be able to start returning capital again. That's been some pretty big buybacks, and I actually think all of them will you know, raise their dividend, which is kind of unique to this year as well. But it just kind of, in the past, you've been able to call winners and losers. It's been kind of a night where who came out the best. I don't think we're actually going to get, you know, specific dollar amount capital plans from many of the banks. To the extent we get some, that'll make it more interesting, but I think it'll be more we're going to raise our dividend X amount, and here's our excess capital under the stress capital buffer. We'd like to return it to shareholders in a, you know, prudent manner or something like that, as opposed to, you know, go back 2 years ago, a company would come out and say, we're planning to buy back $5 billion, you know, worth of stock, and then you could kind of judge that better.
Jeff, from the market perspective, there's been some big underperformance for the financials as of late. Does anything today change the game in terms of how you're thinking about some of these dividends, some of these buybacks, a boost perhaps to the share price?
You know, I don't think it's going to change it a whole lot. I mean, kind of as banks had a pretty nice run, and I think when we started seeing kind of interest rates maybe going another way, it became kind of an excuse for some selling. But when I kind of look at kind of the outlook,
okay, traders, it's time to move up our stop on profit, and I'm going to move to 119.42, just right here. Okay, so well done, guys. You're already in profit. It's all about how much you decided to spend by trading these pairs. I hope you didn't try to spend all 100% of your investing account. It's all about money management, and you can learn this from our strategy or information you will get from company.co.uk. At this point, we're in profit already, £500, and if it will change direction, we will close our position with £500 in profit. If it will move further up, we will increase our stop on profit even further. Okay, stay safe, guys.
important to banking, and these guys have it. So I think the environment we're in here now kind of plays into the big guys' hands, and as we kind of migrate to some loan growth, which I do think we'll see. It's a matter of when, not if, and hopefully some higher interest rates, that then it kind of becomes more broadly good for banks in general.
Jeff, I'm wondering, just zooming out, there is a question of how much financials really hinge on the yield curve. A flatter yield curve tends to be bad.
Also, please move further your stop on profit to 119.43. I said we'll get 5 pips in profit, so from 119.38, 5 pips will give us 119.43. Okay, guys. Sorry, speak to you later.
Not so much. I mean, it's interesting. Bank stocks tend to move with the 10-year, even though, something like the maybe 5-year, 6-month spread means a lot more for their fundamentals. So the stocks tend to move. So as we kind of look at it here, the 10-year coming down typically will bring the bank stocks down. But I don't really think the interest rate environment for them has changed a whole lot over the last couple of weeks. We're still kind of waiting for the short end to go up, and that's what we really ultimately need to see. Ideally, the Fed starts raising short-term interest rates and the curve steepens because they're responding to a strong economy, and that'd be really good for banks. I suppose that the scarier situation would be if they're responding to inflation without that strong economic growth. But as long as the economic growth is driving it, that should be good news for banks.
Jeff Hart, thank you so much for being with us. Jeff Hart, Piper Sandler Senior Analyst for Research. We're getting those stress test results again at 4:30 p.m., the first post-pandemic stress test results. Taylor, you talked about the underperformance of the financial sector, and I do find it fascinating that it really has come on the heels of sort of a rejiggering in financial expectations, that perhaps there is this transitory growth in inflation and that the Fed is correct. I'm wondering, going forward, what is being priced in? To your question, is your sense that people are still going long financials, or that they're backing away at this point because it's all the good news that's already been priced in?
I've heard increasingly notes like UBS yesterday saying that they reiterate this pro-cyclical stance, Lisa, that indeed the market took a little bit of a pullback, but it is this inflationary trade, despite perhaps what the bond markets are telling us within the column on a 210 on a 30-year. But it really has been a little bit of both, maybe a little bit of tech, maybe a little bit of cyclical, but it certainly has not been get out of the cyclical trade, it's done.
Yeah, no, I would agree with you. No, that's actually what I'm hearing also from people who come on this show and other shows. That's exactly what they say as well. They're still doubling down on the banks. I gotta say, it's fascinating to hear about these record highs every single day, really not moving the needle in terms of our shrugging it off. And it doesn't seem like a very active market. But Taylor, is there anything that people say that you are hearing about what could potentially disrupt this?
I think all the conversations we've had this morning, Lisa, maybe taxes being a headwind, but the conversations we hear on the close are, how do you fight M2 money supply? How do you fight a Federal Reserve that says, nope, we're only focused on the labor market despite inflation? And all of those signs, despite some of the hawkish tones we've gotten from some of those Federal Reserve heads, has been, we're in it, and we're in it for good.
Yeah. Mike Wilson pushing back a little bit, saying M2 growth has actually decelerated, so perhaps that could be a headwind. We will continue to discuss. Coming up on Balance of Power, Jared Bernstein of the Council of Economic Advisors. From New York, this is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated. All the world is possible.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City, for our audience worldwide, good morning, good morning. 30 minutes until the opening bow this morning. Equity futures approaching all-time highs on the S&P 500, positive by about 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with a big issue. Market heavyweights pushing back.
The U.S. economy is really on fire.
We're going to see inflationary consequences.
I do think that prices are going up. Wages are the most concerning.
You're going to see the continued inflation. The economy is running really hot.
Too much money, too massive amounts of stimulus.
This overshooting by more and for longer.
There is a danger
that this is ongoing inflation and that the Fed will need to adjust.
I am concerned about inflation.
I don't see the basis for policymakers' serenity.
No question that the Fed needs to go into a period of normalizing rates.
This overheating is likely to necessitate a monetary policy response.
Let's bring in the panel. Joining us now is Stephen Parker of JP Morgan Private Bank and Jean Bavin of BlackRock Investment Institute. Jean, I want to begin with you. This debate continues. It hasn't changed. Many people are sick of hearing it every single morning on programs like this, which is why I've started my program this morning with it again. So, Jean, my question to you is, when we resolve this debate finally, at what point in time do we get that done? Where on the calendar?
Great to see you, John. Thanks for having me. Yeah, I think we've been debating that quite a bit. I think what's interesting is, that was in the cards for many months. I mean, this restart is a powerful force that would be creating significant inflationary pressures. We've been seeing, in our view, what's coming from since last year. Now it's becoming consensus. We are hearing more noise around it from the heavyweights you've just mentioned. I think that, it's real. We think we're breaking to a slightly higher inflation regime than what we've seen over the last, decade and more. At the same time, I think it's kind of a welcome development. That's what what the objective is about. That's what the central banks are trying to do. And I don't think they'll walk away from delivering this inflation soon. So I don't think we are seeing going back to a historical policy response at this stage. And I think that means the Fed remains easy despite inflation coming up.
Stephen Parker, your take, please.
We agree. We think a lot of these inflation pressures are more transitory in nature. We do think that we're heading into a slightly higher regime, but that's for good reasons. It's because growth is stronger. But when you look at some of the parts of the market that have been particularly in focus as it relates to inflation, oftentimes the best cure for higher prices is higher prices. And that happens because it curtails demand a little bit, cools things off, but also because it forces the economy to invest in supply chains to bring that supply back onto market. You look at things like lumber, which have been, which we've all focused a lot more on than I can ever remember in my entire career. And we've seen a massive correction there in prices just over the last month or two. And we actually think that's a good thing. Ultimately, we think that a gradual move to tighter monetary policy is probably in the cards because we think the global recovery will continue, will be prolonged, and will be strong. But we don't think that's a bad thing, particularly if policymakers can message that and ensure that markets aren't caught by surprise.
Well, policymakers are starting to push back. This is what the Dallas Fed President Robert Kaplan had to say, forecasting a rate hike in 22. He said, assuming we meet our conditions, I'd rather start tapering sooner rather than later so that we have more flexibility in deciding what we want to do on rates further down the road. I want to bring in Carl Riccadonna of Bloomberg Intelligence on this. Carl, I feel like we're arguing past each other almost every single day. There is a difference between an adjustment in the price level, which is likely permanent, and the factors behind that adjustment, which may well be transitory, and therefore it's the rate of change that you need to be focused on through this year and into next year.
Absolutely. It's the rate of change that matters, John. So those folks who got a $15 minimum wage working in a warehouse or a big box retailer, that may be a great addition this year, but inflation will erode those gains away. And there's no certainty whatsoever that as the economy normalizes, that 15 per hour will be indexed to inflation or some other sort of growth rate that enables them to keep up. So again, the joy fades as we move further and further into the future and start to lose that positive gain. And here's three numbers to keep in mind: 4, 3, and 2. And these are the forecasts for the end of next year for unemployment, 4%, GDP growth, 3%, and inflation at 2%. So if we're getting to the end of next year and that's the type of economic conditions that are prevailing, that's not all so different from where we were prior to the COVID crisis back in 2018 and 2019 when we were in an economy that did not signal a big inflation problem. So I think we're really being reactionary to a peak growth, peak inflation environment, as we all knew it was going to happen in the second and third quarters of this year. But all of that's going to fade as we get around to the time where policymakers will actually be ready to start normalizing policy.
What do you think that should mean then for the optimal calibration of policy over at the Fed?
Well, I don't agree with the Kaplan assessment of act now so you have more leeway to act later. Chair Yellen, when she was Chair Yellen, made a good point of, the best insurance against having to cut rates in the future is to leave them lower for a longer time now. So let the economy develop, let the recovery mature, let the labor market continue to mend, because we still have 7.5 million workers who have not been reabsorbed into the labor market. So there's a significant potential for scarring there. And so I think that it's not act now so you have room to cut or hike at some point in the future. Rather, maintain those accommodative conditions once we get past this peak so we can really assess what's happening. What Vice Chair Clarida said on Bloomberg Surveillance about a month ago, he said, wait until we get deeper into the year, really to the tail end of the year, to have a sense of what the normalization is starting to look like. And you're already seeing it in the latest durable goods orders, growing, but growing more slowly. You see it in the various purchasing manager surveys, growing, but the pace of growth is starting to moderate. So as the moderation sets in the back half of the year, I think there will be a recalibration of the urgency for policymakers to start doing something.
Carl, it's good to see you. Carl Riccadonna of Bloomberg Intelligence. As always, sir, thank you. Jean Bavin back with us. Jean, I want your view on this. You mentioned something important a little bit earlier. You said we'd move into a higher inflation regime. What's behind that, Jean?
So just to pick on what Carl was saying and then segueing into your question, I think like what we're going through now, we're turning the light back on, right? And once the light are back on, we cannot turn them back on again. So I think that captures a lot of, we're restarting, but it's not like we can extrapolate the kind of numbers we're seeing now for the years to come. So that I think should give us a bit of tempering a bit expectations around growth from here. And in that context, inflation is a real phenomenon. We are seeing demand, a lot of pent-up demand that is turning back on when supply is lagging. So that's the restart dynamic on inflation. But beyond that is the deliberate attempt of the Fed generate this inflation. That's the objective. They are operating under a new framework now where they deliberately want to have inflation above target for a sustained amount of time. And ultimately, I think that's why it's going to be hard for them to be more hawkish than they have been last week. I think that's peak hawkishness for the near term. And exactly because it's going to be difficult to generate this inflation by pulling forward the liftoff much more than 2023.
Stephen, what was remarkable to me and many others as well is that they took just a tiny, tiny step. It was just a re-evaluation of the balance of risks around their outlook, and that was enough to trigger a really big repricing in the Treasury market, which was temporary, down to 135 at the low end on yields earlier this week. Stephen, what was your takeaway from that? Just the signal you got from the price action over the last week?
Well, I think one of the biggest things that we've learned, frankly, over the last decade or so is that markets don't like being surprised by policymakers. And we've gotten used to a Fed and central bankers around the world who have done a really good job of outlining and forecasting and letting markets know the long-term path that we're going to take. I think a lot of markets ourselves, or a lot of investors ourselves included, were surprised by the shift, particularly around some of the views around letting inflation run a little bit hotter for a little bit longer. And I think that's what the knee-jerk reaction was. It was the market questioning whether this is a change in the direction of policy. And I think as we've gotten more information, as we've heard from more Fed speakers, there was a realization that this was really something that was incremental in nature, not a drastic shift in terms of the policy direction, which is why we've seen markets settle back down. And ultimately, we think as long as policymakers can continue to provide that guidance, that markets will be able to digest this, even if that means a gradual shift in policy over time.
So I wanted to finish here with you both then. Is there anything about the past week that has changed your outlook in any way, shape or form? John?
Not really. I think, we're going to see the most muted response of the Fed to inflation that we've seen in decades. That's what the new nominal is about. That's what the new framework is about. That hasn't changed. I think what we've seen last week is, we have a range of views of market participants now that is unusually wide. And that's prime environment for, information coming and being leading to overreaction. And I think as a result, this is what we've seen over the last few days. It's settling down now. I think no big news from our side over the last week.
Stephen Parker?
No change. Continued strong growth, continued supportive policy. Inflation remains contained, which we think translates into sticking with stocks over bonds, staying diversified, and focusing on parts of the market that can deliver that long-term growth, along with barbelling with some of the cyclical sectors that we think continue to have legs as the economy continues to reopen in the coming months.
Jen, stay close. We'll continue the conversation. No change to this market too. We're on course for another all-time high in the S&P 500, 42.51 on S&P 500 futures right now, up another 20. We advance 0.5%. With some of the movers out there at the market desk, here's Abby.
Indeed, John. It's certainly a strong risk-on tone this morning. And similar to yesterday, tech is a big driver. The NASDAQ 100 futures leading the S&P 500 futures, also heading to another all-time high. So not surprisingly, many of the big tech names, Apple, Microsoft, again, both of those names above $2 trillion in market cap. Facebook, NVIDIA, all strong. Now, that is the growth trade that has been outperforming over the last month. But today, once again, we have the reflation trade doing so pretty well as well. JP Morgan, Citigroup, Bank of America higher. This ahead of the Fed stress tests coming out later today. Even with yields in a little bit, the yield curve a little bit, actually the yield curve is a little bit steeper. So perhaps that is what is exactly helping the banks. We have some nice gains here. And then finally bringing it to the Alzheimer's drugs. Eli Lilly popping up 7.8%. They have gained the FDA breakthrough status. This speeds up consideration for approval. Biogen, of course, received this a few weeks ago. Very controversial. You can see the threat of competition taking Biogen down. But overall, risk on tone, John.
Abby, thank you. That's the morning in the equity market. Risk on, 42.52 on S&P futures. Up next, the Bank of England warning against premature tightening, keeping its support in place. That conversation next. We'll catch up with Guy Johnson out of London from New York City this morning. Good morning. 18 minutes away from the opening bell. Equity futures elevated, advancing 20 points, up 0.5%. 42.51. Let's call it 42.52. This is Bloomberg. Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Both the Fed and the Bank of England are struggling in the dark. We've never seen anything like this. And the best thing is to simply wait and see. So any suggestion that they have a clue, I mean, people say things like, I think we're going to tighten in 2022 and 2023. Well, they're just kind of winging it.
What else would you expect from Danny Blanchflower? Good to catch up with Danny a little bit earlier this morning. The Bank of England taking a page from the Fed's transitory playbook, pushing back against calls for a hawkish shift and writing in its statement the following. Financial market measures of inflation expectations suggest that the near-term strength in inflation is expected to be, drum roll, guess what, transitory. Joining us out of London now is Bloomberg's very own and my good friend, Guy Johnson. Guy, take it away. A page out of the Fed's book, maybe.
Yeah, it does sound familiar, doesn't it? Tell me if you've heard this one before, John. We think the recovery looks strong, but we don't want to put it at risk. We think inflation will spike, in the Bank of England's case, to north of 3%, but we think price rises will be transitory. The labour market looks good, but we need to wait until later on this year. In the UK's case, for when the furlough scheme rolls off, John, to get a clearer idea of when the labour market really is going to strengthen back to pre-pandemic levels. There are some hawks, in this case Andy Haldane, the outgoing chief economist, but he can't persuade anybody else on the MPC that it's time to taper. Yes, this sounds very familiar, John.
Not going to resolve these issues until maybe the autumn, the fall, as they would say, on this side of the Atlantic, guys. It's going to take a while.
Absolutely. The furlough scheme needs to roll off. We need to get an idea of what is going on. We need to know what's happening with the Delta variant, now the Delta Plus variant. We need to know what the reopening is ultimately going to look like. You have seen the reopening being pushed back. You saw that showing up in the latest PMI data, John, which took a little bit of a pause in comparison to what we've seen out of the Eurozone, which is reopening and re-accelerating. You can see that in the confidence data that we've seen out of both France and Germany at the moment. But I think it's just a wait-and-see mode. I think it's going to be a quiet summer. The August meeting, I think, is going to be more interesting. We are going to get more data at this point. We are going to get better forecasts. We are going to get a clearer insight. But nevertheless, as you say, John, I think it's later this year before the central bank can really get a gauge of what is happening truly with the UK economy.
No doubt, Guy, you'll go through some of these parallels with Alex Steele in about 43 minutes or so. I do wonder if the differences matter here for the Bank of England. There's no average inflation targeted regime in the same way there is now here in the United States. The additional factor, too, no long persistent period of undershooting the inflation target over at the Bank of England. At times over the last 10 years, quite the opposite. Do you think that makes a difference?
No, it has a history of looking through inflationary spikes, and I think the markets will take that broadly on board, John. Certainly we've seen inflation spike above where the Bank of England is predicting it now, and it looked through it last time. The expectation is that it's going to look through it again this time. The market did take today's statement, I would argue, on the dovish side. You can certainly see that in the reaction when it comes to the pound. But there is a long history, John, of looking through inflation spikes. We've certainly seen it in the past. The market is expecting that we will see it again.
Cable with a gap lower off the back of the decision. Sterling right now 139.26. Guy, looking forward to the show in about 42 minutes. Let's bring back in JP Morgan, Stephen Parker. Stephen, here we are. What's remarkable for so many people is we're this early in this recovery. We've got central banks sitting out of the game, talking about how they won't get involved anytime soon. And yet equities are going to be close to or maybe through all-time highs stateside in about 12 minutes. On the equity side, credit spreads are as tight as they have been since 2007. How different is this recovery compared to the market action, the price action that we're seeing right now, relative to where we were maybe 10 years coming out of the last crisis?
Well, I think we're in a much better place in terms of the stability of the market, the economy, and the financial system today. Coming out of the last crisis, there were a lot of questions around the financial sector. And clearly what we've seen is that banks have built up a lot of capital. They've helped to stabilize. So I don't expect that we will see the same types of disruptions that we saw in the last drawdown. I think this is more akin to a natural disaster, which means that this recovery has been sharper. And we think that for all of those reasons that you mentioned, strong growth, accommodative policy, easy monetary conditions, that means that the pace of the recovery can not only remain strong, but also last longer than expected. And that's the big key. We think that earnings growth is actually going to be stronger than what markets are pricing. And so a lot of the concerns that our clients are expressing about markets at all-time highs, valuations, we think markets are going to continue to grow into those valuations because earnings are going to continue to be strong.
Let's build on that. I want to bring back in BlackRock's Jean Barvan into the conversation. John, when people look at where equities are, close to record highs, where they look at credit spreads, tight, the tightest since 2007, it's hard to believe that this is early cycle in financial markets. How are you and the team at BlackRock thinking about that dynamic?
So I think contrary to 2008 and when the recovery started, I don't think we're seeing now the prelude of a decade-long bull market shaping up. So I think, as I mentioned before, we're turning light back on. I agree this is akin to a natural disaster, and so we're getting it back on the back of it. That is providing a powerful near-term kind of risk support, which is we're comfortable with what we're seeing in terms of valuation at this stage. But at the same time, I think in this environment we're going to see kind of a modest return over the next 5 years. So our capital market assumptions are reasonable but muted expected return. So I think it's a balance between it's real, the restart is real, it's happening, it's supporting markets, but at the same time not extrapolating a decade-long bull market like we had post 2008 on the back of this.
Jean, for those out there that might want to be a little bit more defensive going through the summer, given what we may or may not hear from the Federal Reserve, what are you suggesting they do at the moment?
Well, actually, the first thing I would say is we very much believe that we still should be pro-risk in this environment. There may be a risk down the road on a few years out, but at this moment, we think that the new nominal, the Fed support is still very much in place that provides a favorable backdrop for risk taking. And maybe one way to modulate a bit the risk taking at this juncture is maybe look more now in regions like Europe and Japan, where they haven't benefited as much from the restart. The restart is now broadening and taking maybe some chips out of the U.S. in favor of these regions at this juncture might be a way to modulate some of the risk taking.
Stephen, do you like the idea of that additional international exposure?
Yeah, we've been talking to our clients about making sure that they're at a minimum rebalancing into a global portfolio mindset. After a decade of outperformance of the U.S., it's not surprising that a lot of investors have a much bigger portion of their portfolio allocated to the U.S. And we think there's opportunities both near term and longer term outside of domestic markets. In the near term, we agree with Jean. I think that places like Europe and Japan have some of those cyclical tailwinds, some of the recovery and catch-up that they've lagged relative to the U.S. Longer term, we still think that emerging markets offer really compelling opportunity. They bring a nice blend of cyclical value and secular growth, and a lot of those economies are ahead of the curve in terms of the recovery, and we think that's an opportunity.
Hey, gents, good to catch up. Gentlemen, Jean Bavin of BlackRock, Stephen Parker of JP Morgan. Coming up in the morning calls and later, Wall Street's biggest banks bracing for stress test results. That conversation still ahead with Bank of America's Savita Subramaniam and Jonathan Golub of Credit Suisse. Equities opening up in about 7 minutes' time. Equities up by about 0.5% on futures. Equity futures 42.52 on the S&P 500. We advanced by 0.5%. From New York City this Thursday morning. Good morning. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
About 5 minutes away from the opening bell stateside. Equity futures unchanged through yesterday. This morning, a bit of a bounce, up about 0.5% on the S&P, advancing on the Russell by 0.5, on a Nasdaq by 6. That's the price action. Let's get you some morning calls this morning. We begin first up with Morgan Stanley raising its Apple price target to 162. The analyst forecasting a stronger than expected June quarter, with demand concerns overblown. Your second call from Deutsche Bank upgrading MGM Resorts to a buy with a $54 price target. The analyst expecting the economic reopening to fuel upside growth to its casinos and margins. That stock up by a little more than 2%. And your third and final call from Piper Sandler, downgrading Dollar Tree to neutral, a 102 price target. The analyst seeing inflationary headwinds continuing well into next year. That stock is down to 100 on the button. We're negative about 1.47%. Coming up, the value versus growth debate heating up
with Wall Street taking their positions. That conversation up next with Bank of America's Savita Subramaniam and Jonathan Golub of Credit Suisse. The cash open next with equities approaching record highs stateside. This is Bloomberg.
Okay, guys, position closed on euro. Well done. All of you guys who followed my trade, who decided to copy it, we made 5 pips in profit. It took us 2.5 hours, 2 hours. In our case, we made £500. I'll show you where. In your case, if you found through a broker how much broker pays you per pip, this is profit you get in your pocket. Okay, let's move on. Let's not concentrate on one winning. Let's see what other pairs will give us, and I'll speak to you later. Okay, guys, stay safe. Well done. For the people who want to find out how we trade, why we trade like this, for the people who don't understand, newbies, go to company.co.uk, get the strategy, follow our trades, practice, and this is probably for you will be the best and cheapest and easiest solution to get your second day job. If you want to become day trader, later on you can trade for banks, for hedge funds. It's your choice, because you will know exactly what it's all about to trade stocks, indices, or Forex or Bitcoin. Okay, guys, stay safe.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We're looking down the barrel of all-time highs ahead of the opening bell on the S&P 500 this morning. Good morning. About 15 seconds away from that cash open. 42.55 on S&P 500 futures. Up another 23, advancing about 0.6%. A drift higher on the Russell. On the Nasdaq, 2 up 0.6. That's the cash open. That's your opening bell. Switch up the board and get to the bond market. Yields unchanged, 148.85. What a round trip we've been on over the last week. Basically now where we were on Wednesday morning before that Fed decision, just south of 150. Euro dollar 119.41, a little higher than 0.1%. A stronger euro off the back of better investor confidence, business confidence out of Europe. In Germany, the IFO improves. Outside of that, WTI with a 72 handle, a break of 73, $72 and about 74 cents. We're negative there, 0.5%. That's the cross-asset story, the market desk with your movers. Here's Abby.
John, with that outperformance for the NASDAQ 100, not surprisingly, at another all-time high. Let's start out with big tech and Microsoft opening above that $2 trillion market cap. Not a huge gain, but we do have gains for lots of the tech movers, including Microsoft, Qualcomm, Intel, PayPal even joining in, up 0.8%. D.A. Davidson initiating with a buy rating and a $325 price target, suggesting some upside ahead. We also have strength for the auto space. This is a continuation. Tesla now up for a third day. One of the top stocks for the S&P 500 yesterday up more than 5.5%. Today up 2.5% after the bit of correction, even bear market this year. It seems that investors want back in on Tesla. That is true too for Ford and General Motors. Small gains there, but riding the electric vehicle tailwind. And then finally, John, we have tech working, we have autos working. We also have the other part of the reflation trade mainly working. Conoco's down just a little bit, but JP Morgan, Citigroup, the big banks higher as yields are basically flat, up just a little bit at this point. And of course, ahead of those Fed stress test results released later today at 4:30 p.m. And then Chevron up ever so slightly, Conoco down. But overall, again, a risk-on tone. Most sectors are working. Consumer discretionary, it looks like up top.
Abby, thank you. About 1 minute and 42 seconds into the session, Abby's going to run you through the price action. Through the first 30 minutes of the session here, stateside, we advanced to all-time highs. 42.65 is your new record high in the S&P 500. That print came just seconds ago. Right now, 42.63. Within the equity market, away from the headline number, the value versus growth debate still front and center. Wall Street taking sides with strategists at Morgan Stanley, Cornerstone Macro, Charles Schwab, all warning investors not to sell their cheap cyclical stocks in favor of resilient growers. For more, here's Bloomberg's Katie Greifeld. Hey, Katie.
Hey, John. Well, that's one of the biggest debate in equities right now. What a Fed taper will mean for that growth versus value debate. And the knee-jerk reaction coming out of the Fed meeting last week has been to offload the S&P 500's cheapest shares, those pure value plays. They've been lagging pure growth, the fastest growing companies, for a few years now, but they were starting to make up a little bit of ground. But the idea that the Fed could start to turn off the taps has growth pulling ahead once again. And you can see those diverging fortunes clearly in the correlations. Hey, John, well, that's pure growth and pure value. They're the least correlated right now since 2000. That's after they've been moving virtually in lockstep for years now. That correlation was approaching 1 in April 2020, but it's breaking down now as talking about tapering gets underway. And John, it's worth pointing out that even with this drop, value is still on top for the year. Energy, financials, they're some of your best performing sectors. And you have the likes of Charles Schwab and Morgan Stanley saying, don't call time on cyclicals just yet, that there's still room to run. So we'll see if that outperformance holds.
Information technology top of the pile this morning, at least up 0.8%. Katie, always super smart. Let's catch up soon. Katie Greifeld there on the price action we're seeing. Goldman's Peter Oppenheimer expecting the distinction between growth and value leadership to start fading. Take a listen.
We see a mixture between deep value areas of the market. Banks we were just describing would be one. Commodities, energy, mining would be another similar area where we think there's strong cash flow being generated and some good valuations, but also some of the more defensive growth parts of the market are starting to look quite attractive. Also, from a geographical perspective, much more of a mix in performance rather than such a clear outperformance to the US.
Let's get into this right now and bring in two of the best on Wall Street, Bank of America's Savita Subramaniam and Jonathan Golub of Credit Suisse. Savita, I want to start with just cyclicals, and then I want to get to your industrial call in just a moment. For the cyclicals, why do you want to stick with it still?
Well, I mean, it's the economy. It's basically the broadening out of the economy. We haven't reopened the world yet. We've just started in the U.S. and we're starting to see that kind of drift across the Atlantic. I mean, I think that the easiest call to make right now is to stick with cheap stocks. But I think what's interesting is that some cheap stocks a year ago are no longer cheap, whereas other stocks have remained cheap because earnings have basically kept a pace. So I would stick with the value call. I would stick with a select group of industrials. But to your point, not everything looks great right now. And industrials is one area where we do think that things have gotten pretty pricey off of the low levels that we saw last year. Okay. But I think that the call on cyclicals remains intact unless we're heading into a slowing down of the economy, which it really doesn't look like. None of our economists are calling for this. I would stick with the cyclical bias.
I'll turn to industrials in just a second. Just hold that thought, Savita. I know you want to get there. Need to get Jonathan Golub into the chat too. John, you agree on a cyclical side, just reading your research, they'll carry on leading on both profits and returns. That's your call.
It is, and I think that if you said to me, would you rather be in growth stocks over the next 5 to 10 years? I think the answer is yes, and we will get back to that point in time where growth is going to lead. But the economy, and I'm right on the page with Savita on this, where the economy is just too strong. And I don't think it's a growth versus value thing. I think it's a cyclical thing. You want companies that are really exposed to economic improvement, and a mining company, an energy company, a mall retailer, all of those do much better in a re-accelerating economy where the FANG stocks and the tech stocks, they do well. They're kind of all-weather companies. They do well under all conditions, but that means this is not their moment in the sun right now.
Let me give you the stage now, Savita. Forgive me for cutting you off. The industrials, why aren't they the optimal way of playing this?
Look, I think that industrials have been kind of a chicken way to play the reflation trade. So we've seen that industrials have grown very crowded by institutional investors. They've grown incredibly expensive over the last 12 months off of the nadir. So I think that, the better way to play reflation, economic reopening, higher oil prices is energy. I also like financials. I think financials is still cheap, but industrials has been kind of the chicken energy sector. It's been the way that investors have been able to have access and exposure to oil without actually holding oil stocks. So I think that there is this really interesting disconnect right now where industrials actually looks pretty expensive, pretty crowded. And then you've got these deep value sectors like energy and even select materials that haven't really participated in that institutional investor buying. What I worry about is industrials doesn't actually look all that green. I think folks are buying it because it's more kind of green than energy, but it really isn't. Industrials actually contributes the highest percentage of carbon emissions to the S&P 500. It contributes 30% of total emissions of the S&P 500. So I think that it's a sector that offers up what investors think is a greener way to exploit the oil price move, but it's not. It really isn't. And I think the better way to do it is buy energy.
Three sectors there that you mentioned, the financials, the industrials, and energy. Let's save the banks just briefly, John, and go to that call on the industrials. Less bullish, less constructive over at Bank of America, much more so on energy. Where's Credit Suisse on that, John?
Yeah, I think that the two groups that participate the most here are going to be energy and financials. But I to a certain extent, I think it's not worth the effort to try to make a call on materials versus industrials versus retailers. The big call is this. This is going to be an incredibly powerful reopening process, and you want to buy the top half or top third of the market that is going to win during that play. And you could be really nuanced and say, I want to buy transports, or I want to buy machinery names, or I want to buy, EMP oil exploration companies. But I think in reality, it's just avoiding companies that are, number one, more defensive in their nature. Areas like consumer staples and utilities, I think those are going to be clear laggards. And I think tech is going to be a market returner. The differences between the cyclical groups, I think, are going to be much more subtle. And I don't think you need to make a really nuanced call there if the economy remains as strong as I think it's going to be.
Well, it depends if the price pressure comes along for the ride in a much more pronounced way. And Savita, I wanted to go there. You and the team have done some tremendous research on this. Companies with high employee-to-sales ratios. Can you walk me through what you see in the data and how it shapes your views on the sectors you want to be in and the sectors you want to avoid?
Yeah, thanks for the question. So I do think that we're moving into more of a stock picker's market. So I would say you can't just buy all cyclicals and you get to the same place. To your point on inflation, industrials is, I think, the third most labor-intensive sector in the S&P 500. Consumer sectors are 1 and 2, and then industrials. There's a huge tightness in the labor market, and our analysts have been writing about this. I think that's going to translate into margin pressure, especially in a sector that's pricing in really strong earnings growth over a period of time where, I think banking on this infrastructure deal coming through and benefiting CapEx beneficiaries isn't necessarily a slam dunk. So I would focus on pure inflation beneficiaries, which aren't industrials. Industrials has too much margin and pressure from the cost pressure that you're seeing from labor and other raw materials. So I think that's what you want to really pay more attention to. And I guess I would say that we are moving into more of a nuanced market environment. We've seen this cyclical rally where, to Jonathan's point, all cyclicals did really, really well for the first half of this year. I think we're moving into an environment where you really want to pick your spots and look at labor inflation and labor intensity as a way to kind of differentiate between the good and the bad cyclicals.
There's some subtle nuances between the both of you. You're both pretty optimistic about the future. You're both looking to play it through cyclicals, but John, I have to say, Savita is far more nuanced than you. Why are you a little bit different on this?
Well, first of all, let me just maybe just one point that I kind of agree, but have a slightly different view on is this idea of costs. We found that right now pricing power is unbelievable. Companies' ability to pass on costs, despite higher labor, despite higher input, is really high. So we see very, very little margin pressure. We think that companies are focusing, and they always will, on the downside risks of having higher oil prices and copper prices and labor. But what they don't say is, you have no idea how much we're increasing our prices. Take a look, because it seems unbecoming. But that's the reality here. So I do agree with Savita that you want to focus on those companies that can pass on the pricing, that have less downside risk for margin squeeze. But we're seeing that much, much more broadly. And the economy is so disrupted, Jonathan, in terms of who can open up and who can move their products about and who can get parts and who can get labor, that it is really, really difficult to be nuanced. I mean, last quarter, on March 31st, at the end of the first quarter, the consensus on Wall Street was for 20% profit growth. We ended up with 48%. When you end up with numbers that are this big because the dislocation is this large, trying to use a scalpel when the right tool is a chainsaw is a mistake. So I do think that Savita's right. We prefer energy over industrials. Absolutely. I prefer materials over industrials. Absolutely. I do think there's a margin squeeze incrementally in retailers from from the inability to get labor back into your retailer.
Well, so that's a nuanced call, though. I mean, that's a nuanced call, right? I mean, Jonathan, you're making a nuanced call. You're saying you don't like consumer cyclicals, but you like the CapEx plays. So I think that you take that a step further and you say, okay, yeah, and I think the point you made is excellent. Right now, we're not seeing pricing. We're not seeing a margin squeeze. That's right now. But if you look at every regime model, like we have a regime model that basically tells you that right now, we're moving from the cusp of an environment where, pricing power has been great and companies have been able to offset rising costs with prices. But we're moving into an environment where inflation actually starts to impinge.
Any model that you use in an environment where this is going to be the strongest GDP quarter since 1952. So how did your models don't have any ability? None of us do. That's the key. You and I.
Jonathan, it's also going to be the biggest pickup in inflationary pressures that we've seen in our careers. And I don't think you can ignore that. I don't think you can sit in a vacuum and say,
we've also never seen this amount of price pressure.
That's my point.
There is just it's okay to disagree, but I think that this environment, and this is really why I'm not recommending that you be more nuanced, and there will be a time for it, is the data is so large. It's so, with the seasonal adjustments on the economic data, we don't even know, they're just not as reliable as they normally are because of the disruption from coming into the into the crisis and out of the crisis. That the biggest thing to do is catch the big wave, ride it big, and then be nuanced later.
Well, okay, how about this though? Why do industrials always perform right in the middle of the pack? I mean, this is what we've seen every single cycle. So my point is, don't be a chicken. Buy energy, buy financials, go for the gusto, go for the reflation plays. I agree with you. I think the economy is going to surprise to the upside. I think earnings are already surprising to the upside, and that's likely to continue. But I don't think you need to be a chicken about it. I think you can buy the sectors that directly participate and avoid the market performers. I think you're right about tech, but I think industrials falls into that same bucket of a market performer. This is a sector where there's cost pressures, there's CapEx, there's, industrials is a very heterogeneous sector.
If we want to get more
really
nuance,
well in an economic recovery.
We want to get more nuance, even on industrials, they're not the same. Defense contractors are almost like consumer staples. You don't want to be buying them. Would you buy someone who leases industrial equipment? They are like an energy company.
Well,
would you buy someone who makes the machinery and the engines?
You're getting nuance.
No, that's right. But if you're making the industrial call, even that, needs more nuance.
I've never seen two people who agree so much with each other who appear to disagree. But I've enjoyed the last 5 minutes. We've got to leave it there. Jonathan Golliver, Credit Suisse, Savita Subramanian of Bank of America. Guys, always fantastic. And that was brilliant. Thank you very much. Coming up, the big banks facing a big test after the closing bell. That conversation coming up next. And the markets right now in and around record highs. From New York City for our audience worldwide, this is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
Back.
We had a record first quarter. The strategy of balancing a wholesale bank or an investment bank with a consumer business anchored primarily in the UK and the US, I think paid off last year. I think it paid off quite strongly in the first quarter.
Barclays CEO Jez Staley weighing in on the strength of his bank during Bloomberg's Qatar Economic Forum. This is major US financial firms brace for the results of the latest Fed stress test results. Could we be getting a few more payouts? Let's bring in Bloomberg's Taylor Riggs for more. Morning, Taylor.
John, that is certainly the consensus here. Look, this is the first post-pandemic stress test results that we're going to be getting. A lot of hypothetical scenarios, of course, about what it looks like in an economic downturn. And then, of course, we've had some real-world examples. Let's think the Archegos blow-up, for example, right? Some fat finger little mistakes. But overall, the consensus has been from Betsy Graseck over at Morgan Stanley, for example, look for an accelerated capital return plan in the second half of 2021. Let's take a look at buybacks. buybacks, for example. It doesn't look like anyone should fail. They all passed last year, and they've held on to a lot of capital since then. Banks can start to return that capital, which, of course, will be in buybacks. This is according to Jeff Hart of Piper Sandler. And, of course, expecting most to raise their dividend, too. We may not, though, get specific dollar plan amounts just yet, John. But that dividend story, if we take a look at the chart in the terminal, also an interesting one, because you've had an extra dividend advantage of the financials. Now, some of that has been fading just a little bit in terms of what makes that sector attractive, because year to date, you're still the third best performer. You're up 22%. We've heard from Jeff Hart this morning, of course, that June pullback wasn't really surprising, given that massive run-up that we've already had in the sector.
And Taylor, another story for you and I to discuss tomorrow morning. I believe you're with us again yes. on Bloomberg Surveillance, early doors. Bloomberg Surveillance tomorrow with Taylor Riggs, Lisa Abramis and myself. TK will be back with us on Monday. All-time highs in this equity market, 42.67 on the S&P, advancing 0.6% with the sector price action. Here's Dave Wilson.
Thanks, John. 9 of the 11 main industry groups in the S&P 500 are higher in early trading. Energy and consumer staples kind of being left behind here. Financial stocks up, but not nearly as much as big tech, whether you consider technology or communication services, where you find Google's owner Alphabet as well as Facebook, and the consumer discretionary category where Tesla is helping things. But healthcare really leading the way today, and specifically Eli Lilly, after U.S. regulators designated the company's proposed Alzheimer's treatment as a breakthrough therapy, kind of clearing the way for accelerated consideration of that drug, and Lilly planning to file for approval this year. So within healthcare, you're seeing a bit of catch-up for the drug stocks relative to the biotech companies, because Biogen, which got approval for its Alzheimer's medicine a couple of weeks back, is lower in response to what's happening at Lilly. So you look at the year-to-date, the biotech stocks have in general been doing better, but today, you've got a bit of catch-up for the drug makers.
Dave, good to see you. Dave Wilson on the sector price action. At the index level, all-time highs, 42.68 on the S&P 500. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary. From New York, this is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
we're about 25 minutes into the session. Stateside, your equity market, all-time highs on the S&P 500, up 0.6%. On the Nasdaq, up by 0.75%. That's the price action. Here's the trading diary. As always, like every other single day that ends with a Y, we have a host of Fed speak kicking off at 11 a.m. Eastern, with President Williams, Bullard, Kaplan and Barkley following throughout the rest of the day. President Biden holding bipartisan infrastructure talks at 11:45. The Treasury auctioning $62 billion of 7-year notes later on this afternoon. And of course, we'll get bank stress test results from the Fed at 4:30 p.m. Eastern Time. Finally, personal income and spending numbers and the Fed's PCE deflator rounding out the week on Friday. From New York City, this was the countdown to the open. We'll bring you some highlights of that conversation with Jonathan Golovitz and Vita Subramaniam a little bit later through the day, and of course tomorrow morning as well. We'll respond to that. From New York, this is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all of this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease beside disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication?
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. Because I think life happens. I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.